Hello, students. I hope I'm audible and visible. Is my face also visible? Just a sec. I'm trying to set things up. Just give me one sec. Yeah. Good morning, everyone. Good morning. Can you please confirm if I'm audible and visible? Okay, great. Good morning. So we'll start this session at 11. There's a 2 minutes delay, so kindly excuse that. But the idea is, we should do it till about, 4 o'clock or so. We'll have enough breaks in between because, I also cannot continuously speak. There is also, how much I can actually speak continuously. So what we'll do is we'll probably, go on for an hour, have a 5 minute break, then again go on for another hour, then have a 45 minutes break at least for lunch, so that those of you who are having lunch, planning for lunch can have it. I can also have my lunch. Then we will after that we'll continue again. Every hour or so we'll take a 5 to 10 minute break. Now the key things that I want to highlight in this are as follows. Okay, this is AFM Revision. You're able to see this on screen. Now, I am focusing specifically on, I'm going to focus specifically on 4 chapters today. We'll have one more, session tomorrow. But today's session will first start with Forex. A lot of students have, trouble with this particular chapter. So I thought that why don't we start first with a chapter that is considered troublesome for a lot of students. Then we will try and have a look at derivatives, all heavy chapters. Then we look at interest rate risk management. And then we will, if time permits, we will also look at risk management as a chapter. Right. So we'll try and cover these 4 chapters to the best extent possible. Now, if you're trying to cover 4 chapters in a span of 5-6 hours, the issue that typically ends up is whether you're doing justice to any chapter, because Forex alone, the revision probably could easily take 4 to 5 hours. So the idea here is I should help you guys prepare for the upcoming exams rather than try to show off what all is there in Forex. Or what are all the various aspects in Forex. Rather than focusing on that, we will try and cover important concepts and certain important problems. Okay. Important concepts and important problems. I think we'll cover roughly about 17 problems here. I made a list. 17 problems here, then about 13 odd problems here. Then I think I made notes here, about 9 odd problems and a couple of problems here. Right. So that is the plan. In this 17, total how much? 11, 30, 41. So we'll try and see if we can cover 40 problems. And what I will do is when I go through each chapter, my focus is not only going to be on, solving these problems. That is one aspect, but explain some basic concepts, then explain some bit of advanced concept, not every advanced concept or not every complication, because Forex itself has multiple complications. We'll not get into all complications. We'll try and cover more important complications or important twists and turns or whatever, they are. Then we will also try and specifically focus on some theory aspects. And I'm not saying every theory aspect, some theory aspects, which are particularly relevant for upcoming exam, because these are new topics that have been added, right? I will not go into each and every topic. I'm not going to, in depth of everything, but I will definitely go into in depth of certain things, which I think are very important, specifically the new topics. Okay, so that is the plan. And second thing, what I've given is, if you guys can actually see, it is there in the description of the page, this particular video itself. So I have shared with you what are all the things you anyway have access to the ICA website and study material. I'm going to share with you, if you can see on screen, this P590, the link is visible. Then you have, important questions. This list I made and, I'm sharing it. This important questions list also, the link is available in the description. Then we have formula sheet. I've given the formula sheet. Then P380, T380, which is basically my theory questions of all across all chapters. I'm going to be primarily using these documents along with, of course, ICA material wherever required. And, there are some cases where people want only incremental theory. So there is a separate document for incremental theory and incremental practical questions, new topics, problems, what you can see on screen here. Right. So I will cover all of those, wherever required, wherever relevant, and all of that. And of course, there's a tax table, the standard, the normal distribution, because we're covering a derivative chapter. These are all there. These are the kind of tools that I'm going to use in today's session. Okay, before we go there, there is one thing I want to show you guys. Just, don't think of it as marketing or anything, but the idea is very different. Idea is that, those of you who are writing the exams first time and have not enrolled in a full-fledged course, right? For the AFM, I'm not referring to SFM, I'm referring to AFM. In AFM, if anybody wants only incremental topics, you can visit our website and there is a tab here, which is AFM incremental topics only for May 24 exams for SFM students. Okay, so this is about for 999 or so. It is about, I think, 20 odd hours. I mean, it is fairly extensive. So any of you who feel that these additional topics you wish to enroll or anything like that, please go ahead and buy. Even if you don't buy, it's okay. But I will not, please don't expect that I will cover 100% of everything in this, because it is practically impossible. When you're revising, even when you do your own personal revision, you will not be doing 100% of everything. Okay, chalo, after all this discussion, about how I'm going to do, what I'm going to do, what are the key aspects, what I'm going to cover. Let us first, go and start off with the first chapter, which is Forex, which is what I wanted to take you guys through. And this is, T380, whatever theory questions, 380, what I have. And, from that, I will start off. There are about how many questions? 35 questions. I'll not be dealing all the questions. Please don't worry about it. What I will be taking is basically helping you understand basic stuff, and then we'll jump into respective questions. So what we'll do is we will cover some theory aspect, go and solve a bunch of questions, cover some more theory aspects, and then go and solve some more bunch of questions. Okay. Okay. So let's begin. Let's begin this marathon and trust everything goes well. Okay. So first is in Forex, right? A lot of people get confused between direct and indirect quotes. The easiest way, if you ask me, is to remember that India, remember the word India, right? India, always think, you're a direct resident of India. So India is a direct quote. What is India direct quote means? Rupee is 84. 84 rupees for $1, right? So this is called as a direct quote. What do you mean by direct quote? Direct quote means quote of $1 is equal to 75 rupees. This was made when it was 75. Now it is 84. Don't worry about it. That is how much one unit of foreign currency will cost in terms of home currency. Or another way to look at it is there is something called as base currency and price currency. Okay. Now, base currency is $1. So you will always quote for $1, and price currency is rupees. Okay. So when you quote USD INR, so this is the international nomenclature of quoting Indian rupees versus dollar, as 84 or 83 or whatever the rate currently is. You are saying for $1 how many INR? Okay. Now, ICAI in its infinite wisdom does weird things like INR per USD. They say rupee per dollar. Okay. USD by INR. They use everything interchangeably. Okay. They complicate stuff. Okay. Please don't get complicated. Think of the number very, very clearly. Think of this number as USD INR or rupees per dollar or USD by INR or INR by USD, or even if sometimes they've used dash also, INR dash USD. Okay. They've used a variety of things. So don't bother about all of that. Think, if you see the number 84, think of it as USD INR, where the quote is number of rupees per dollar. Okay, this is the first one. Next part is, if this is the case, then actually I noted down yesterday's rates also, because I wanted to tell you guys which price is where and all that. Where is it? Okay, I'll show that rate to you separately, but idea being the costliest or strongest currency is, first is GBP, followed by euro, followed by probably CHF. CHF and euro, there is a, they're very close. Then USD, then CAD, SGD. CAD is Canadian dollar, SGD is Singapore dollar, then AUD, which all of them are stronger than INR, and INR is stronger than your JPY. JPY is yen. So if you remember broadly, this thing that GBP, Euro, CHF, USD, this is the order. You will, you will know when you see the quote key, what is it that they're referring to? Are they referring to which currency is stronger, which currency is, dearer, things like that, you will very, very clearly understand. So if you remember this broadly, everything else will become easier. Now coming back, which is direct quote. So direct quote is one of base per for one base currency, how many units of price currency. And across the world, all the currencies are quoted as direct quotes only, that is against USD. Whereas, except there are exceptions. Exceptions are your GBP, Euro, then CAD, I think then NZD also is probably quoted. So there are 4 or 5 currencies which are indirect quotes against USD. Whereas all other currencies are quoted as direct quotes against USD. So USD INR, USD ZAR, USD JPY. So you'll have varieties of quotes. Right. All of them are direct quotes except for these 4, where against USD they are quoted as indirect. That is, for 1 unit of GBP, how many dollars? Okay, this is the normal nomenclature. In exam, if they give something slightly different or anything, we will figure out depending on the questions that come in. Okay, now moving back. Right. So this is indirect quote is for 1 rupee, how many dollars? So we've seen this. Direct quote, indirect quote are ulta one the other. Next concept, what I want to tell you guys is about something called bid ask. Bid ask. A lot of students get confused on bid ask. What is this whole bid ask? So rupee is quoted as 83.45 by 83.50. So what they mean is, this is bid, this is ask. Bid means buy, ask means sell. Now, when they're referring to bid, buy and sell, they're referring first to the bank. That is, the person who's making the quote. Who gives you a quote? When you have to buy currency, you don't ask your uncle or you don't ask your friend for quote. No, you go and ask a bank. So the person who's giving a quote, right? This buy and sell are from their perspective. That is the first aspect. Second, these buy and sell are for base currency. So in USD INR 83.45, 83.50, base currencies USD. So for 1 unit of USD, what are they willing to buy? What are they willing to sell? So basically what they're saying is, bank will buy $1 from, let's take a student, Ramesh. Okay. From Ramesh at 83.45 rupees. Okay. And sell $1 to same Ramesh. If Ramesh wants to buy dollar, bank will sell dollar at 83.50, right? That is what we had. So bank is always out there to make money or make profit. So they will try and always sell you something costly, buy something from you cheaper. Okay. So this is second aspect that you have to remember. And please note, there is an easy way to remember this. What I teach in the class is BBBBC. Banker bids to buy the base currency. Banker bids to buy the base currency. Okay. So if you remember this logic, you will know that first one is bid is buy, second one is ask is sell. and banker will buy the base currency. So their quote, whatever they're quoting is for the first, whatever the price that is being quoted. If they want to buy, if the bank wants to buy, they will buy $1 from you at 83.45. If they have to sell you a dollar, they will sell it to you 83.50. Please, one way I at least used to remember when I started out was always think everything in terms of rupees. Even if they give CHF, SGD, whatever it is, they give to some crosses or something. What is a cross? We'll discuss. But even if they give anything, you primarily consider everything. Think of it. How will you deal with it in rupee terms, and then work backwards on it. Okay, so that is one way to look at it. Then these are two major aspects that I want to highlight before we move forward. Then we look at other things. Pips is basically the smallest unit with which exchange rate is quoted. So let's say you have a tick size. If you look at this USD INR 75.12241234. So the change is how much? 24 to 34. That is 10 pips. So the last few decimals, instead of quoting as 0.0010, you're calling it as pips. Okay. Then what are bid and ask? We just discussed. Cross rate. What is cross rate? Cross rate is a rate which is expressed by pair of currency, none of which is the official currency of the country in which it is quoted. That is, exchange rate between pound and dollar is quoted in India. So if you're looking at crosses means rates which are not with respect to rupee, but with respect to two other different currencies. So as per market convention, exchange rate expressed by any currency pair that does not involve US dollar are called cross rates. Okay. Then tick size, we also said tick size is basically the size at which the quotes are given. So if you ask for currency, they will say 83.4025. If after some time they will say 4050. They will not give you 4037. They will say the currency is quoted in multiples of 25 pips. Okay, it is quoted in multiples of 25 pips or 0.25 paisa. So that is the NSE's nomenclature. Then participants in foreign exchange market, I'll not get into this because you all know this is theory. Tourists, banks, foreign exchange brokers, central bank, there are a bunch of people. Spot and forward. Spot is buying today so that you get delivery of T+2. That is, if you buy shares also today, you will get delivery after 2 days. Okay, India introduced a T0 also, settlement for shares. But typically world over, most of the stocks and currencies, everything is T+2. So if you're buying spot, it means that you'll get delivery after 2 days. Forward means anything beyond 2 days is called forward. So the difference between these two, forward rate and spot rate, let's just say spot is 84.00, spot on today, day 0. Okay. Then for day 90, if you ask a forward, let's say it is 85. So the difference, and I'm taking only bid side. Okay. Okay. Don't again ask bid or ask bid. I'm first explaining. So it is 1.00. So it is how many forward points? It is 100 forward points or 1 rupee. Or you can, let's say it is 84.50. Then it will be 50 forward points. Let I'll just clean this up. If it is 84.50, then it is 50 forward points, right? So this is called forward points. So now this is something I want to specifically show you. SWIFT. This is a new thing that has been added in the syllabus. There is very high likelihood that either you may get MCQ. That is one more important thing in the new exams. MCQs are going to be asked, and these can be asked from anywhere. They can be very, very direct questions, or they can be indirect questions also. So here, I would strongly suggest that you please go through this something called a SWIFT. It is nothing. It is just a messaging system. Okay. Society for Worldwide International Interbank Financial Telecommunication is purely a messaging system. It employs a dedicated computer network for communicating fund transfer. So people, if I send money to abroad, let's say I send money to Google or for running ads, right? So, or I send money to Amazon US, or I send money to Microsoft US or something like that. And I send it through a banking channel, not credit card. Okay. I send it through bank channel. I go to bank, follow the FEMA rules, file a form A2 and all of that. Bank will send a SWIFT message to the, my bank is the sending bank. They will send a SWIFT message to the beneficiary bank. Beneficiary bank will receive the message. They will say, oh, this fellow has sent money to this particular bank. These are the details and all of that. So this thing is a messaging system. If you know, when Russia-Ukraine war started, across the world, they actually stopped the Russian government from accessing SWIFT. So Russian banks actually suffered a lot because they were no longer allowed to access SWIFT. So a lot of their payments got stuck. So they have given out codes for various currencies, USD, GBP, CNY, so on and so forth. You can go through this. That is not the important thing. Important thing is SWIFT is a messaging system. It is between interbanks. It is used to communicate, messages in a safe and efficient manner. Then it uses common language and uses centralized data processing system. It is important to note that it's only a standardized communication system, not a transaction settlement system, because these are things that can come in MCQs. Okay, it can more than 200 countries, its important role and all of that. It is a quick form of quick settlement, enables reduction of operational risk, standardized transactions, bring efficiency, so on and so forth. A bunch of theory aspects around this. You please go through at your convenience. But the idea is this is a very important topic. Second important topic which I want to cover is payment gateway. So what are payment gateways? All of you would have seen in, when you buy on Amazon or Flipkart, or even when you enroll with us on Indigo Learn, we basically, use a payment gateway which will specifically help you using your debit card or credit card or UPI to move money into our bank account. So it doesn't directly come to our bank account. It goes to the payment gateway. From the payment gateway, there is again a reconciliation. It hits my bank, and from it goes to some nodal account, and from there it comes to my account, right? So what is a payment gateway and what are advantages of payment gateway? Please go through. Okay, please go through. These are very, very important things. And as I said, I have given a separate file or a separate document called AFM May 24 versus SFM November 23. What are the additional questions? There are 120 questions. Please go through all of them. The details, chapter by chapter, the new topics and new questions are given. Please go through all of them. You can download it. The details are available in the description of this particular video itself. Incremental theory, incremental illustration. That is basically what is the name of the files. You can directly click on them and download. Okay, just moving back. We were here. Right. What are disadvantages of payment gateway? Please go through. I'm not going to elaborate. What are international payment gateway? This is also fairly important one. What is an LC? This from here on, these are all old questions only. There's nothing. But what is an LC? It is basically sort of a guarantee provided by our bank to the exporter bank, so that we as importers will end up paying and will not default. Right. USANs and site LCs. USANs means typically for 90 days, 120 days, 180 days, 300 days. Site means there is a specific time period, that is within 25 days you have to make the payment on submission of relevant documents. Then all this, covered interest arbitrage, factors affecting exchange rate. I will not get into too much of depth. I will just explain broadly three theories: interest rate parity, purchasing rate parity, and international Fisher's effect. The idea is, whenever, how are currency rates determined? So today rupee is at 83. After 1 year, so 1120x1. So after on 31,120x1, what will be the rate? The rate will be very simply 83 into 1 plus domestic by 1 plus foreign. Here, when I'm talking about foreign, this 83 is against US dollars. So India interest rate, let us say, is 7%. 1 plus 7% by let's say US interest rate is 4%, 1 by 4%. Okay, if you do this, you will get the exchange rate. This is a theory. So on an exact basis, this will not happen. But over a long term, your foreign exchange rates will mean revert to this particular rate. That is every year, whatever. So suddenly you'll see appreciation, suddenly depreciation. But over a long term, if you see, it will be following this pattern. Okay. So over a long term, it may be like this, like this, like this, but eventually they will follow. The rupee will be 81, 82, 83, 84, like that. But it will not exactly be 82, 83. Sorry, this is time. This is rupee level. So 81, 82, 83, 84. It will not be exactly, next year, exactly at this point, this is how it will be. Nobody can predict, but it will broadly move in that direction. Okay. So if you look at this, these three theories, interest rate parity basically says is the forward rate is linked to interest rates. Then if you look at, purchasing per parity, Spot rate is basically a function of price levels, basically inflation. They are saying that it is linked to inflation, where instead of interest rates, it is linked to directly to inflation. Then if you look at international Fisher's effect, it basically expected spot by current spot is again linked to interest rate. So expected spot by current spot, the rate that you will get will be same as 1 plus domestic by 1 plus foreign rate. Okay, so these are the three theories you have to remember. That is why foreign exchange rates move. There's an explanation of what are these theories, what is the linkage and all of that stuff. There is about technical forecasting and all that. I'm not going to get into all of this, right? So these are all things that you are supposed to anyway study. I'm not going to get into this because if you get into this, there's no end to it. Okay. One important question that I want to highlight is what is an EFC account? This has not been asked earlier, but there's a potential or there's a chance that they can actually ask because you have to understand what's an EFC account. It is an account in which you maintain. Indian people are not allowed to maintain money in dollars generally. Okay, you and I can maintain money in savings bank account, current account, or FD account. But if you have an EFC account, you can maintain money in dollars. That is allowed only for exporters and importers and not for anyone. Right. Then various techniques and all that. This all I will not get into it. What are the external money market hedging? Money market hedging, we'll come to that. We'll come to all of that. Difference between forward and future. This you should have ideally studied in derivatives. We will anyway be covering in we will anyway be covering forwards and futures when we get into the derivatives topic later today. Right. Currency options and futures, again, options and futures, very similar to, you will learn about it in derivatives chapter. Now, the key thing is nostro, vostro, loro. We will come to this. I will, stop for a moment, this discussion about theory. And let's move to now practical questions, right? Because we have understood some basic stuff. Using this basic stuff, what are the problems that we can solve? Let us go and have a look at it. Right. Now, in theory, let me move to practical questions. Yes. Right. Practical questions. This is also again freely accessible for all of you. You can go and download it in our website. Forex is 343. The link is not working, so I'll go to that page. We will come back to it. Don't worry. We are going to come back to the theory part. Any points that we have missed and all, I'll be coming back. We'll spend roughly, an hour and a half or two close to on Forex. So we will try and solve a good number of problems. There are about 17 problems, what I highlighted earlier. So first problem that we're going to solve is problem number 8, 10, and 12. Okay, so because there is no way I can solve everything. There are some 90 odd, 98, 99 questions in Forex. There's no way I can solve, and there's no way you will also be able to do it. And then this class will never end. Okay, so I will solve specific problems. These are again part of the important questions. So if you are not aware of this, I have shared a PDF, which is part of this description of this video, important questions, chapter by chapter. List of important questions is given here. So I'm going to cover these questions. From these important also, I have now taken some questions and I'm covering them in the class now. And this also can be downloaded. This is linked to my P590. Okay. P590 is basically the question bank, right? Compiler come question bank plus, whatever you want to call it. Right. So now coming to illustration 8. Based on whatever small, learnings we had, basic learnings, we can solve this. So the question is, you are a Forex dealer of your bank. A Forex dealer of your bank, are informed that your bank has sold TT on Copenhagen. What do you mean has sold TT on Copenhagen? We'll see. For Danish kroner of 1 million. 1 million, right? So some of you may have confusion. What is million? 1,000 is 3 zeros. Million is 6 zeros. Billion is 9 zeros. Okay, easy, very simple way. Lakh is 5 zeros, 10 lakh is 6 zero, crore is 7 zero, 10 crore is 8 zero, 100 crore is 9 zero. Okay, so 1 billion is equal to 100 CR. Okay, 1 million is equal to 10 lakhs. Any of you have confusion? Just to clarify. Okay, they have sold 10 million, 1 million, basically there are 6 zeros, Danish kroner at the rate of 1 is equal to rupees. So what is this? This is again a simple direct quote. Direct quote of Danish kroner. What is the DKK? DKK is the terminology. So DKKINR is 6.5150. Okay, very simple. you are required to cover the transaction either in London or New York market. The rates of that date as on that date are as follows. Okay, so this is bid, this is ask. So when they give you stuff like this, you have to figure this out. Okay, there are some other small minor concepts that I will explain as we move along with subsequent problems. Now, yeah, so they sold a TT on Copenhagen for Danish krone. So what does and they're saying that the following are the rates. In which market will you cover the transaction, London or New York, and what will be the exchange profit or loss in the transaction? Ignore brokerage, and this is a steady material question. So let us look at the solution. There are two legs. What is it that we have basically done? You have to first understand what is that has been done. Your bank has sold a TT on Copenhagen for Danish kroner. So you have basically sold your bank. You as a bank have sold it. So you are basically transferring money out, right? You're basically transferring Danish kroner. So your customer is giving you rupees and you are converting the rupees into Danish kroner. And you are making that particular payment. So you are buying the Danish kroner on behalf of your customer and remitting out, right? That is what it is. So if that is the case, in which market will you cover the transaction, London or New York? Okay. So now if you see in Mumbai, London, they have given you rates. What is this rate? This is the rate of GBP INR. And Mumbai, New York, this is the rate of USD INR. This London Copenhagen, this is the rate of, see, if Danish kroner is 6 rupees, each kroner is 6 rupees, obviously, it is cheaper than pound also, no? So GBP DKK, and this is USD DKK. These are the, terminology. And here, this is the base currency, right? Now, what is it that you're supposed to do? You are supposed to first, I've directly jumped to the solution. You have to first buy USD. And this is for whom? This is for the dealer. You are as a dealer and you have to cover this. So when you're required to cover the transaction, what do you mean by required to cover the transaction? You basically have to buy that particular Danish kroner. Why? Because you have to buy it and then you have to, once you get it, you sell it to the customer and that customer wants to make a remittance abroad. So you have to buy. So if you have to buy, there is no direct quote available in India for Danish kroner. You see, there is a quote available either for GBP or a USD. Okay. And GBP and USD have, rates with Danish kroner. But in India, it is not quoted. But you have quoted a rate and then you have sold it off, right, to the customer, and customer is remitting that particular money. So now what you have to do is first you have to buy USD and sell INR, because why? The customer has given you INR so that you can give him the customer Danish kroner. So with that INR, you buy USD. Then with that USD, you buy DKK. This is one way. This is when you're doing through the Mumbai, New York route. Then second way is when the customer gives you INR, you buy GBP, and using the GBP, you buy DKK, right? This is the second route. So let us look at the first case where you do it through USD. That is, you as a banker do it through USD. Now, what are bid and ask? Bid and ask rates are already given. 49.25, 49.2625. This is one rate. And New York, Copenhagen. Copenhagen is the capital of Denmark. Okay, so sometimes you should know things like that. DKK is 7.5670 and 7.5840. So those numbers are written. Now, in this, you are a banker. Now, banker is doing what? Banker is buying currency. When banker is buying currency, banker becomes a customer. Interbank becomes the banker. So this is another very, very important aspect. Okay, so banker is going to buy the currency of USD. He is basically a banker bids to buy base currency. But are you the bank? You're not the bank, you're the customer. So bid and ask, if you want to buy as a customer, bank has to sell. So if a bank has to sell, the rate applicable is this. So the interbank will sell you. So let us say our bank is called what bank? They have not given a name. Let me call us as FD, and this is interbank. So we are a foreign exchange dealer. The foreign exchange dealer becomes customer. Interbank becomes the banker. So banker has to sell you dollars. So banker has to sell you dollar. Ask is what is applicable, right? When banker has to buy dollars from you, bid is applicable. When banker has to sell you dollars, this rate is applicable. So you will buy 49.2625. You will buy $1 at 49.2625. Where did you get this money? 49.2625 from your customer. Then once you get this, you will go to Mumbai. You'll go from Mumbai to New York. That is where where you can exchange this for kroner. And you will sell this USD and buy the Danish kroner. How will you sell USD? So you're again a customer. So what is this quote? This quote is also base currency, right? In this quote also base currency is USD. Base currency is USD. This is bid. This is ask. Interbank has to sell you what? They have to sell you base currency or they have to sell you price currency. If they sell you base currency, this is the code. If they have to sell you the price currency, this is the code. Or if they have to buy, when they buy base currency, it means they're selling base price currency. So I'll explain this again, just in case you got confused. Base, bid, ask. Okay. Okay. Let me say customer, no, buy, sell. Okay. Uh, buy, sell. No, not this way. Let me explain it even better. Customer. Let's say USD INR. So if your customer wants to buy, the quote applicable will be buy USD. This is the quote, right? If customer wants to sell USD, this is the quote. If customer, and when customer buys USD, what is customer doing? Customer is selling INR, right? And when customer is selling USD, customer is buying INR, right? So exactly ulta will be the bank. So when bank is buying USD, which means selling INR, this is the quote that is applicable. Banker bids to buy the base currency. So they will buy this. The base currency is USD. So they will bid is the rate applicable. And when bank sells USD and buys INR, this rate is applicable. So these two are same and these two are same, right? So if you come back here, the applicable rate is this because they have to buy Danish kroner. So basically they have to sell USD. So the interbank will buy base currency of USD and sell them DKK. So this is the rate that is applicable. Now let me clean this up. Right. Now, given this, how much USD will this person get? So if let's say, and they have said what? 1 million Danish kroner. So how many USD will you get? How many USD are required to get 1 million Danish kroner? How will you arrive at it? 1 million Danish kroner. Okay. For getting 1 million Danish kroner, what do you have to do? First, you have sold it at which rate? This rate. So how many will the customer give you? Customer will give you 6.5150 into 1 million. So 6.5150 into 1 million Danish kroner. This is the rupees that you will have. This rupees you will convert into USD. You will convert by dividing by 2625. Right, rupees per USD. So basically you will get number of USD. You will get USD as 1,32,250. Let me use a highlight. That is a better one. Right. So you'll get 1,32,250 USD. With this 1,32,250 USD, you go and exchange this for DKK. What is the DKK rate? We have already figured out here. So how many DKK will you get? 132,250 into 7.5670. So you'll get a DKK of 1,741,000. Now, what is this telling us? This is telling us that initially you sold off with whatever money you got, you sold off 1 million DKK. When you went and covered, you got 1 million for the same amount of rupees that you got from the customer, you got 1,741,000 DKK. So you basically made a 741 DKK as profit. So 741 DKK, again, you can convert it into rupee terms and, it will be probably 4,800 INR. You can get into that number. You made a profit of 741 DKK. Same logic will apply when you're going to GBP INR as well. Right. So I was just checking the student queries if there were any. So one more thing, please ask queries, but then I don't think I'll be able to answer every query. Okay, because what happens is, I know it's a marathon, but then there is only so much time that I can, spend. If I keep on solving a lot of queries, if I believe some query is important, I will definitely take it up. But if I keep solving every query, then I don't think we'll be able to finish this marathon today. Okay, we have to cover a bunch of topics. There are 15 chapters. Today, hopefully, we'll cover 4 chapters. Coming back. Now, same logic happens for GBP also. So especially when you look at this kind of thing, no, and if you have solved this correctly, don't rethink on what is bid, what is asked. Just fill up the data and directly take the rates. Whatever is the ask you have taken, bid you have taken, same logic you apply here. Don't overthink. Okay, so 1 million into 6.5150 divided by 74.32. And you do this, then you'll basically eventually end up with a gain of 1.1093 DKK. This 1093 DKK can also be looked at it differently. How will you look at it differently? I'll explain the second part here. DKK INR, what is the code? 74.32, which is the 74.32 divided by 11.42. How are you getting that? USD INR basically refers to rupees per dollar, correct? GBP INR refers to pounds per, rupees per pound. I'm sorry, my bad. Rupees per pound, right? What are the codes that we have? GBP DKK, right? GBP DKK refers to DKK per pound. Follow the same logic. GBP INR means pound is at the bottom. So GBP DKK is pound is at the bottom. Now, if you have to get rupees per DKK, what will you do? This is 1, this is 2, 1 by 2. 1 by 2, what will happen? These two will get cancelled. So rupees per DKK. Simple logic. So 1 is what? Rupees per pound, which is what? 74.32. We have it from here. Then 11.42 is GBP DKK. So take it from here. 11.42. So you get a rate of 6.5079. But the banker sold it at 6.5150. Where did I get 5150? It is part of the question. Banker sold it at 6.5150. So you've sold it at, you're covering at 5079, but you've sold it at 5150. So the difference between those two is 0.0071. This many INR per DKK. So 0.0071 into 1 million DKK per INR. 1 million, that is DKK, no? Into 1 million, I'll write it clean. Yeah, into 1 million, you will get 7,100 rupees. Okay, so this is basically the logic. Okay, so this profit in DKK, profit in INR, both these numbers we have put, and if you look at it, GBP INR is giving you maximum profit, so just go with it, right? So the answer is, since profit in INR in case 2 by following GBP INR, dealer has to cover it in London. Okay, because this is the first problem, I went step by step, covered multiple things, but I don't think I'm going to do that for every single problem because we have 16 more problems to cover. Okay, so just coming back, let us look at the next question. Next question is question number 10. Just one sec, guys. Okay. Following a spot exchange rate quoted at 3 different markets, USD INR, GBP INR, GBP USD. So you've been given 3 different rates and quotes. An arbitrager has US dollars. Again, how many zeros? 1, 2, 3, 4, 5, 6, 7. That is 10 million. Assuming that there are no transaction costs, explain whether any arbitrage gain is possible from the quoted spot exchange rates. So there are 2 possible scenarios which are here in this particular thing. So either go like this or go like this. My suggestion is start with top to bottom. Go with the normal logic, which is if you have USD, convert them into INR. So USD convert to INR, INR convert to GBP, and GBP convert again to USD. See, you start with 10 million. See if you have greater than 10 million or less than 10 million. You go through this logic, then you'll figure out, right? If you get less than 10 million, then probably the reverse way can work out, right? So just directly start off with what is given. Don't try and overanalyze things. And please note here, they have not given you bid ask also. It is super simple. So you have 10 million. So if you have 10 million at rate USD, how many INR will you get? You multiply simply with 48.3, which is the 48.3, the rate. If they've given bid and ask, then you have to, what rate will you have to give? USD INR, let's say they gave 48.30 by 35. And which rate will be applicable when you sell USD and get INR? Then bid rate will be applicable. Why? Because banker will buy the base currency. Base currency here is USD. Right. See here, they've said USD by INR. It does not mean number of USD per INR. It actually means USD INR is the quote. Base currency is USD. INR is the price currency. It is number of INR per USD. So please don't get confused with what they give. Please remember the logic that I told you in the beginning. Right. So you get how much? 10 million into 48.3. You get 483. 10 million is what? 1 crore. 1 crore into 48.3 is 48.3 crores. Very simple. Right. So you get 48.3. Then from this INR, once you get INR, you convert it into GBP. GBP rate is what? 77.52. So you divide this by 77.52 to get number of GBP. So you'll get 623.0650 GBP. It is very simple. Once you get rupee terms, from rupee, you have to convert into pounds. And pound is stronger than rupee, so you'll get lesser number of pounds. Then you again sell the GBP and get USD. What is the exchange rate? Please note here 1.6231. And I told you pound is stronger than USD. So when you convert from pound to USD, you'll get more USD. So if you have 1 pound, you'll get 1.5 USD. Right. Here the case is 1.6231 USD. So whatever pounds you have, 6230, you multiply with 1.6231, you'll get 10 million plus pounds, 10 million plus USD. So you sold 10 million initially and got back 10 million 112,969. So basically there's a profit of 112,969. So this is a straight profit. Now what can be done? Ulta. Ulta is you start from the bottom. You say, what is start from the bottom? You have USD, convert it into pounds. So you convert USD into pounds, so you divide by it. So you get 616, right? You divide by 1.6231, you get 616, 6161049, this number of pounds. Those pounds you sell and get INR. How much INR will you get? You get 477,604,583. And that INR you again convert by dividing by 48.3, you will get 9.8 million. So initially you sold 10 million, but you got back only 9.8 million. So there is a loss. So as I suggested, always first case is preferable. And you give a saying that you give a conclusion saying that first case is preferable as there is a gain of so and so number of dollars. And the note for you is always start from top to bottom and see where it goes. If it goes, you're getting profit, it is great. If you're not getting profit, obviously it means that is wrong. So choose the next method. Right. Next question that we're going to solve is question number 12. 12 and 15. This is a good one. This is a very good one. This is a lengthy question. So somebody says, please write the crux. Crux. What is the crux in this particular question? I don't know. I've given the solution here. Okay, let me see. In subsequent questions, I'll try and see if I can write a crux. Next question is what? Question number 12. Question number 12. You have following quotes from Bank A and B. So USD CHF 1.46. Okay, GBP USD 1.76. Please note, when you don't know what is the whether CHF is stronger, USD is stronger, and all that, very simple logic. Very, very simple logic. GBP USD is 1.76, meaning GBP is stronger, USD is cheaper. So same logic applies here when you say, and for 1 GBP X USD, you are getting 1.76 USD are required for 1 GBP. So for 1 USD, 1.46 CHF are required. You remember I told you that in today's day and age, Euro and the CHF are stronger than USD. But in this question, this was probably long ago, very long ago time. At that point of time, CHF was weaker than USD. So be careful in what is given, especially because they don't give the quotations right properly. So anyway, if you look back at this is the key of this particular question, okay? understanding what is dearer, what is cheaper. So if you look at this particular question, this is bid ask 5 and 10, 10, 15. Bid ask moving positively. This is where is the issue. GBP USD 1.7645 and 60. So it is going up here. But 3 months spot, 3 months forward points, right, are 25 by 20 and 35 by 25. What it means, this is at a currency. This is not forward premium, but forward discount. Why am I saying discount? Here, for bid, 1.4650 by 55, you're adding, for 3 months, you're adding 5 here and 10 here. So this becomes 1.4655 by 65. But in this case, you have to subtract. Why you have to subtract? Because the forward points are reducing. Here, 5 to 10, it is increasing, whereas here it is reducing. So you subtract 1.645 minus 25 and 60 minus 20 to get the bid ask for forward rate. That is a key crux of this particular question. Okay. Now, what is the question? Calculate how much minimum CHF amount you have to pay for getting 1 million GBP in spot. So first question is with respect to spot. So all your stuff around the forward points is irrelevant at this point. All that is relevant is only the spot, right? So what is the spot here? Spot is this and this, this and this. And who are you? How much minimum CHF amount you have to have to pay for 1 million GBP. So forget USD, only relevant thing is GBP. Right. Now, point here is you are not given directly GBP CHF rate. You are given CHF USD, USD GBP. So you have to arrive from CHF into GBP. So how much CHF are required for 1 million GBP? That is the question. So that is also the second important point. So if you look at the rates, 1.465055, 53 by 60, and 1.7645 and 40 by 50. I've just copied and pasted relevant rates here. Now, for USD, CHF and GBP, USD. Now, the key thing is, since GBP, CHF, GBP quotes are not given, we have to first convert CHF into USD. So, whatever CHF you have, so you first need pounds, right? So, first, whatever CHF you have, you can't directly go to pounds. First, go to USD, then go to GBP. So, let us assume, what is the exchange rate of CHF USD? CHF USD is given as this much. And here, 1 USD is giving you so many CHF. So, for 1 USD, you get this many CHF. So after getting USD, we will exchange USD to GBP at this rate. So the way to look at it is, first convert from CHF to USD, from USD to GBP. So for you to convert USD to GBP, what is the relevant rate? GBP USD, right? So GBP USD, you have quotes from both the banks. Which bank will you choose? 4560, 4050. So you will choose this quote because this is cheaper. In this quote also, will you choose bid or ask? What are you trying to do? You have in your hand USD. Why do you have USD? Because first you had CHF, you converted it to USD. USD, you are now selling. If you are selling USD and buying GBP, banker has to sell you GBP, right? If you are buying GBP from bank is selling you GBP. So in this quote, GBP USD, base currency is GBP. So banker will bid to buy GBP. Banker will ask to sell GBP. So banker has to sell you GBP means ask is relevant because banker bids to buy base currency. So ask is banker is asking to, if banker is bidding to buy base currency, then ask is for selling. So if they have to sell you GBP, the relevant quote is ask. So this 0.50 is relevant, right? So you have to, if the how many USD are required, if you want to get 1 million GBP, banker will have to sell you at this particular rate, 1.7650. So that is the relevant rate. So so how many USD you'll have to give? You'll have to give 1 million into 1.7650. That is basically you have to give the banker 176,500 USD to get a million GBP. Right. Now, if you have to get 1.765 USD, how much CHF are required? Again, same logic. The base currency is USD. So banker will bid to buy base currency. But here the banker has to buy base currency. So you basically are selling, right? So you are selling your CHF and buying the dollars. So again, the ask portion is relevant. And which one is a better quote, 50, 55 or 53, 60? 50, 55 is better. So we will take the 55 ask, right? So what you will do is 1.765 million dollars what you have. To get that many, you have to give them multiplied by 1.4655 CHF. So you will have to basically give 2.58 million CHF to get 1.765 million USD, which you will convert and get into 1 million GBP. Right. So thus to get 1 million pounds, one needs to pay a minimum of 2.5866. Why am I saying minimum? Because quotes are available. I will choose the quote that is most convenient to me. So for GBP USD, I will choose this quote because this is cheaper. And in that quote, I will choose the ask. For USD CHF, I will choose this quote. And in that course, I will choose the ask. Right. So that is why you require minimum this money. Now, second question. What is second part of the question? Considering the quotes from bank A only. So ignore bank B. Right. For GBP CHF, what are the implied swap points for spot over 3 months? Swap points. The swap points relevance comes in for 3 months. So ignore again 6 months. That is irrelevant. So GBP CHF. Right, they're asking you GBP CHF. So you have to first get USD CHF, then GBP USD, and then arrive at swap points. So you see here, what is the spot rate? 1.4650. That is what is given. Right, because we're considering only bank A and in that also only 3 months. So the relevant rates are this. So 1.4650 and 4655. Forward premium is 5 paisa, 10 paisa, because it is very clearly the market is at a premium because the bid and ask spread is increasing, right? So 5 paisa here, 10 paisa here, or whatever the number of CHF. It is not paisa, huh? It is CHF. So you get 1.4655 by 1.4665. Whereas if it is, you look at GBP, I said it is at a discount. So you have to subtract 1.7645 and 7660, less forward discount. So this is the crux of this question. So, and how much is the discount? 25 and 20. So you subtract 25 here, you subtract 20 here, you get 1.7620, 7640. Now for GBP CHF, how will you arrive at GBP CHF? We already arrived at something here. What did we do? We did something where we, just a second, just 1 sec. I have to stretch. Huh. So GBP CHF, we need to multiply ask to get ask points. Similarly, we need to multiply both bids to get bid points. So how are you going to do? What did you do here? You multiply for 1 million pounds, you multiply 1 million 1 million CH. I'm sorry. For you getting 1 million USD, you multiply with 1.7650, and then to get convert that into number of dollars, you got $1.765 million. Then you converted this dollars into CHF to get the CHF value. So this was basically a pound rate. This was the CHF rate. Correct. Same way you have to multiply both the rates here as well. You multiply 1.4655 into 620. What is this? This rate. This rate multiply with this rate. Ask also you multiply this rate with this rate. Right. So you get 2.58221 and 2.58906. So this is the forward rates. Is that the question? Considering what are the implied swap points for spot over 3 months. So you want to first for 3-month forward also rates, you want for 3-month spot also. So how did you get spot? Spot is very simple. Directly take the spot. 50 into 45, 55 into 660. 55 into 660, 50 into 45. Directly multiply, get this rate. So you have to give answer as forward and spot and the difference between those two. Swap points of forward over spot means you have to find out the spot rate, you have to find out the forward rate, and the difference between those two gives you forward points. So the forward swap points will be, you subtract these two, you'll get 0.0028 and 0.0012. I'm approximating them. Swap points will be 28 by 12. 28 by 12. Of what? Of these rates, right? Forward and spot. So for spot of 2.58807, you add 12 pips here to the end, you'll end up at this number, which is the forward, right? So that is how you basically work. Now I think this 4 decimals, so we'll ignore this. Yeah. So 2.5869, 5880. So for 5880, you subtract 12 basis points, you'll arrive at the spot because this is also at a discount. Okay, guys, just give me 1 sec. We will just continue. I just need to stretch. Okay, there's nothing else other than that. I'll just stretch. I'm just putting myself on mute. I'll come back in 2 minutes. I'll come back in 2 minutes. Okay, I'm back, guys. Okay, so now moving forward, we have finished illustration 8, 10, and 12, fairly lengthy ones, in fact. Let us move to illustration 15. This is the next one. This is also on arbitrage and stuff. So let us look at this. So first few illustrations, in fact, I've actually mentioned in my this thing also, what are the types of questions that are there? These are all basic types of questions. Then we'll get into slightly more specific ones. USD $10,000 is lying idle in your bank account. You get the following quotes from dealers. Euro USD is this much, Euro GBP this much, GBP USD this much. Is there an opportunity of gain from these quotes? This is a November 20 question. Now, relevant rates are as follows. So what I've written, this is a solution. Euro USD, this is basically Euro GBP, GBP USD. So if you look at it, you'll understand GBP is the base currency. So 1 unit of GBP, this many USD are required. So GBP is stronger than USD, whereas Euro is weaker than USD and weaker than pound, and Euro is stronger than USD. So Euro is strong, here weak, this is strong. So which is what I've been telling you. GBP is the strongest, followed by Euro, followed by USD. Now, you have how many? $10,000 lying in your bank account, right? $10,000 lying in your bank account. So what are you supposed to do? Is there an arbitrage opportunity? There is an opportunity of gain from these quotes. So arbitrager has $10,000. So you can first sell USD and get Euro. Why am I saying this? Because you first have Euro USD, right? So you have to convert that into Euro. So each Euro is 1.159 USD. So if you have 10,000 USD, you will get lesser number of Euros. So basically you divide. Right. So you divide 10,000 by 1.15, you get 8,666. Once you get the euros, you have to convert it into GBP. Euro is weaker. I wrote Euro is weaker. So if you will get lesser number of GBP when you convert Euro into USD. So you have to multiply. So GBP into Euro into GBP Euro exchange rate. So you'll get this many GBP. Then what next? This GBP, you have to again convert into USD. So you have some number of GBP and GBP is stronger than USD. So if GBP is stronger and you have some GBP, X GBP, you will get more than X USD. So you multiply. So 7.81 into 881 into 1.27. This is another way of looking at it. Right. So you get 10,000 USD in the end. So by doing all of this, you got 10,000 USD. So initially you invested 10,000, you got back 10,049.98. Now, Ulta case is basically you will get a loss. The reason is simple. You are following everything Ulta, right? Which is from USD, you move to GBP, from GBP, you move to Euro, from Euro, you move to USD. Obviously, if one case gives you profit, the second case will give you a loss. Okay. Then this is question number 15. This is also done. Now, these are basic questions. Now we are moving to arbitrage, IRP, PPP related. Here, arbitrage and IRP, basically whether, these are related to interest rate parity theory and all of that. So let us see. Following are the rates quoted on Mumbai for British pound. Right. 52.6 by 7 is the spot. Interest rates in India are 8% and 10% for 3 months, 6 months. In London are 5% and 8%. So 3-month forward is spot points. These are basically forward points, 20 by 70 and 50 by 75. Verify whether there is any scope for cover interest arbitrage. Same logic like what we saw earlier, but this question has much clearer numbers. So I think this should not be much of an issue. Just a second. Right. So let us look at this question. Spot, pound rupee, that is number of rupees per pound. is 52.6 by 52.7. And 3-month forward is you add 20 bips and 70 bips for bid and ask, and 50 point, not bips, points, 50 points and 75 points for bid and ask for 6 months. So what needs to be done? Your interest rates are like this: 8%, 10%, 5%, 8%. Right. Borrow INR. If you can, they specifically said if you can borrow in rupees, verify if there is any scope for arbitrage if you borrow in rupees. So let us borrow in rupees. So if you borrow in rupees today, you will what? You borrow, you borrow INR equivalent to GBP. So if you borrow and then convert it into borrow in rupees and convert it into pounds. If you're converting into pounds, you are selling INR and buying pounds. For buying pounds, the rate is this: bid and ask. This is bid, this is ask. So when you are buying pounds, you have to give more INR. So you have to borrow 7,000, right? 52,700. I'm sorry, 52,700. You're going to borrow the number of INR. That INR will give you exactly 1,000 pounds on spot. So you're borrowing it for 3 months at 8%. You're borrowing it for 6 months at 10%. Now you convert this INR into pound, you will get divided by 52.7, you'll get exactly 1,000 pounds in both the cases. Now you invest this 1,000 pounds in FDs in both the cases. And once you invest in FD, how much interest will you get? You'll get 1,000 pounds into 1 plus 5%. Why 5%? In pounds, the interest rate is 5% for 3 months and 8% for 6 months. So you invested 5% for 3 months, you'll get 1012.5 pounds, and you invested 8% for 6 months. That is basically 8% into 6 by 12 is 8% by 2, which is 4%. So 1 plus 1.4%, you basically get 1,040 pounds. So the rate that you've got here is the pounds that you've got in 3 months is 1012.5 pounds and 1040 pounds in for after 6 months. Now you have to convert these pounds back into INR. And what are the codes? Codes here are given for 3 months and 6 months. 3 months, 6 months, you already have pounds. You have to sell them. When you are selling, the banker is buying. So when banker is buying, he is buying at the bid rate. So 52.60 plus 20, which is 52.80, 52.60 plus 50 is 53.10. So the relevant rates are 52.80 and 53.10. Right. So 52.80, if you, is the equivalent, is the desired rate. So what you do, you divide, you multiply, this is the number of pounds you have, you need rupees. So you multiply 52,700, you multiply 1012 into 52.8. So 1012 into 52.8, you get 53,460. Same way you multiply 1040 with 53.1, you get 55,224. So you basically have this much money at the end of 3 months, this much money at the end of 6 months. But you also have to repay the original loan. What is the loan you took? 52,700 at 8%, 52,700 at 10%. So the loan value at the end of the period is 53,754. How? 8% for 3 by 12. So 8% by 4, which is 1.02. So you have to repay 52,700 into 1.02 and 52,700 into 1.05. You get both these numbers. This is the loan repayment, rupee loan repayment. This is rupee converted from pound, right? So rupees converted from pound minus rupee loan repayment. So if you subtract these two, 53,460 minus the loan repaid of 53,754, you get 294 as loss. And here you get 111 as loss. So in both the cases, there is no scope for arbitrage. In both the cases, there is no scope for arbitrage. Right. Newly added theory, I already covered initially a small bit of it. In other aspects, I will cover it slowly. Okay, this is question number 22. Then we'll go to question number 26. This is very similar to question 17. Let us see if here the data is given properly. Just give me 1 sec. I need to drink some water. See, we'll attempt to cover as many questions as possible now. and then we'll break for lunch. And post lunch, we'll try and cover the fate of forward contracts. Right, we'll try and cover fate of forward contracts post lunch, so that there are 3 or 4 questions there. So we'll try and see if we can cover another 4 or 5 questions now before we break for lunch. Right. Now coming to question number 26. Mary is a forex dealer with XYZ. She noticed following information related to Canadian dollars and German Deutschmark. CAD is 0.775 per DEM, Deutschmark, German Deutschmark, and CAD is 0.780 per Deutschmark. Assuming there's no transaction cost, does interest rate parity hold? If you explain the steps that would be required to make an arbitrage profit, ignore decimal points and all. This is the same question. Instead of 0.675, they have made it 0.775. So let us look at it. So forward is spot into 1 plus domestic by foreign. This is what I was telling you earlier. So forward rate is quoted as 0.78, but ideally it should be 0.775 into 1.9%. What is 9%? Domestic currency, right? And what is the quotation here? 1 Deutschmark, how many? CAD. So this is the base currency. This is the quote or price currency. CAD is the price currency and Deutschmark is the base currency. Now, for 1 unit of Deutschmark, how many CAD are you getting? So you are getting CAD of 0.67. So CAD is basically stronger, right? So, and domestic rate CAD is 9% and Deutschmark is 7%. So domestic rate is 9%. So 9% by 4. Why are we doing by 4? Because we are trying to arrive at 3-month forward. So 1 plus 9% by 4 by 1 plus 7% by 4 into 0.775. What is 0.775? Your spot. So you multiply these two, you basically will get a number which is ideal forward. Ideal forward is 0.779, but actual forward that is quoting in the market is 0.780, right? Now, so 3-month theoretical forward as per IRP is 0.779, but current forward is 0.780. So theoretical price is not equal to the current quote and IRP does not quote. So following steps need to be undertaken to calculate profit. So same logic what I was telling you earlier. If you want to make profit, you have to sell the the one which is quoting abnormally. So abnormally high. So you can make money by selling this. Selling what? 0.780. You can make money by selling at 0.780, right? What is selling at 0.780? You are trying to sell, you're selling, what currency are you selling here? The quote is 1 unit of Deutschmark for how many CAD, right? So you basically have to come here, right? So you basically have to sell some Deutschmark at 0.780, right? The quote currency is CAD, the base currency is Deutschmark. The Forex rate, forward rate, which is incorrect, is forward rate of this 0.780. So you basically, and this 0.780 is for 1 unit of Deutschmark. So you basically have to agree to sell that 1 unit of Deutschmark on a future day at 0.780. So that is the agreement you should enter in so that you basically end up making money. So you enter into a forward contract to sell some Deutschmark. Okay, we'll get into that number, how we got that number. But for you to get that number, where do we start? We say first, borrow CAD. Why do you have to borrow CAD? Because why do you have to borrow CAD? Because towards the end, you have to sell Deutschmark. If you have to sell Deutschmark, you should have Deutschmark. If you have to have Deutschmark, there has to be some way in which you get a deposit, or you make an investment in Deutschmark for which deposit comes out after 3 months, which you will sell. So you have to make a deposit in Deutschmark, but you don't have money in Deutschmark. And when you don't have money in Deutschmark, you don't directly borrow in Deutschmark, you basically borrow money in CAD. So initially you borrow in CAD. You borrow in CAD at what rate? At 9%. Why 9%? Because the rate is given of CAD as 9%. So you borrow in CAD at 9% at 0.775, which is spot. Then you convert the CAD into Deutschmark at spot rate, which is 0.775. So you get how many Deutschmark? You get more Deutschmark. So you get 1290 Deutschmark. This Deutschmark you invest at 7%. Why 7%? 7% is the rate for Deutschmark investment, right? So you invest it at 7% for 3 months. So 1290323 plus 7%, you get a value of 1312904. 1312,904 is the dash mark that you will get in the end. This dash mark you will convert into forward. So initially you enter into a forward contract to sell that many number of dash mark. So this step 1 no is actually arrived after you finish step 6. So even in the exam, you please write all of this, then come back from step 6 to step 1 and say, I'm going to sell this many dash mark, right? So you will sell this many dash mark and convert it into CAD. You will get CAD of 10 million. No, 1,024,000 CAD. So 1,024,000 CAD you have. But with this 1,024,000 CAD, you are supposed to repay the original CAD loan. What is the CAD loan you have taken? You have taken a CAD loan of 1 million at 9%. So 1 million at 9% will basically mean that you have to repay 1,022,500 CAD. So this 1,022,500 CAD you have to repay, but you have how many CAD in hand? You have CAD of 1,024,000 in hand. So from this, you subtract this, you are left with a profit of 1,565 CAD. Because both of these are in CAD terms, no? So you subtract this CAD from this CAD, you get actually CAD as profit. So Mary will make a riskless profit of CAD 1,565 by entering into above transactions. Okay, next, moving to next question. 26 is also done. Then we move to 35. How many questions have we solved? 1, 2, 3, 4, 5, 6, 7. We're at 7th question. We have solved 17 questions. So let's see. We'll move forward. The Treasury Desk of a global bank incorporated in UK wants to invest 200 million on 1st Jan for a period of 6 months, and it has following options. The equity trading desk in Japan wants to entire 200 billion GBP. They want all the money so that they can invest in high-yielding Japanese securities that would earn a dividend income of 1182 million. The dividends are declared and paid on 29 June. So after 6 months, basically on 29 June, 1 day before the 6 months end. This post-dividend securities are expected to quote at a 2% discount. After the dividend, securities value will fall. The desk also plans to earn JPY 10 million on stock borrowing and lending scheme. Now, what is the stock borrowing and lending scheme? Stock borrowing and lending scheme is if you have some stocks and you're not going to use them, you can lend it to somebody so that they can do whatever they want. Right? They want to short a stock or something. They want to do anything. You basically are lending securities. And for lending securities, you get a return. So they will earn 10% return by lending these securities. The securities are to be sold on 29 June with a T+1 settlement and the amount remitted back to Treasury in London. So they will sell on 29, get the money on 30th and remit the money back to London on 30th. The fixed income desk of US has proposed to invest in 6 months G-Secs at return of 5%. So somebody else has given alternative opportunity to invest it at 5%. Now, what are the exchange rates? First Jan spot is GBP, JPY, GBP, USD. Forward is GBP, JPY, GBP, USD. As a treasurer, you are required to advise the bank on the best investment option. So what is the surplus money you have? You have 200 million. And here there are no bid-ask concepts, so it is very simple. You will convert that into JPY. So please note, GBP is stronger than JPY. So you'll get more JPY. So you multiply 200 into 148, you will basically get 29600.04 million. Student is also million, by the way. You get so many million JPY. That JPY, what are you doing? You're investing in a stock. You are getting dividend income of 1182. So you add the dividend income. Then there is a reduction in price of 2%. So 2% on this 29,600, there's a reduction which is 592. Then you're earning stock lending, you're earning 10 million. So total net investment value on at the end of 6 months period, you have 29,600 plus 1182 minus 592 plus 10 million, you end up with 30,200 million or 30 billion, basically. That you again convert back to GBP. How will you convert? You will use this exchange rate of forward rate, which is at 150. So you divide by 150, you get 201 million GBP. Now you invested 200 million, you got back 201 million. Now, if you do the same exercise with US, what will happen? GBP, you have 200 million GBP. What is the exchange rate applicable? 1.28. So here also what GBP is stronger than USD. So when you convert it into USD, you'll get more USD. So into 1.28, you get 256 million USD. That you invest in what? You invest in GSEC. invest the amount in 6 months GSEC that provides 5% in return. So invest this 256 into 5% into 6 by 12, you basically get a return of 6.4 million. So your total at the end of the 6-month period, the money that you have is 262 million. This 262 million, you again convert back to GBP. How will you convert? You'll use the exchange rate after 6 months. What is the exchange rate after 6 months? 1.30. So you divide by that. 262 by 1.3, you get 201. So what is the value that you're getting? 201.33353. 201.33359. So which one is giving you higher return? The JPY is giving you higher return. 33359 versus 33333, which is basically GBP 0.00006 million. That is 60 pounds. After doing this entire activity, you finally got only 60 pounds. By investing in JPY equities, one can make 60 bips over 6 months. But given the fact that 60 bips is very small, investing JPY equities as compared to US G6, one should invest in G6 considering it is much less riskier or much less riskier. Right. So this is the question number 20. This is question number 35, I think. This is question number 35. Okay. So the answer is for 60 pounds, why do you have to do all this activity? Now somebody has asked a question. In question 22, can we borrow amount in GBP and any possibility to make profit? Question number 22. What was the point? No, you cannot. You can borrow in GBP. Abhijan, the answer to your question is yes, you can borrow in GBP and make a profit. But the question specifically says if you can borrow in rupees and make a profit. So we're answering to the question that no, if you rupees, you cannot make a profit. But what point you make said is very right. If you borrow in GBP, you will make a profit. Because if you're borrowing in rupees, you're making a loss. Obviously means if you borrow in GBP, you will make a profit. Okay, let's move back. Move to question number 42. These are what questions? Is there any variety is there? This is about loan, where comparison of your loan versus the domestic loan versus foreign loan and all of that stuff. Right. So let us look at this. DEF has imported goods to the extent of 1 crore. The payment terms are 60 days interest-free credit, and for additional credit of 30 days, interest at the rate of 7.75% will be charged. The banker of DA offered 30 days loan at 9.5%. The quote for foreign exchange rate is as follows. Spot is this, forward rate is this, 90-day forward rate is this. Right. Which of the following options would be better? Pay the supplier on the 60th day and avail a loan for 30 days, or avail the supplier offer of 90 days credit. Now, if you look at this question, right, they are imported. How much? 1 crore USD. 1 crore USD means what? 10 million USD. Payment terms are 60 days, interest-free credit, and additional credit at 7.75%. The banker has offered a loan of 30 days at 9.5%. Now, question is, pay the supplier on 60th day by borrowing from the bank, or borrow from the supplier itself for entire 90 days? That is the question. So if you pay the supplier in 60 days, how much will you pay? 60th day forward rate is 63.15. 63.15 into 10 million. Basically, 1 crore is 10 million. So you pay 63.15 crores on 60th day. But you have to borrow the same money at what rate? Banker is offered at 9.5%, no? I don't know why it is written 10%. It is 9.5%. You borrow at 9.5% for 30 by 360. Now, have they said whether you have to use 30 by 360 or 30 by 365? They have used everywhere 30 days, 90 days, so which is why we use 30 by 360. So you get an interest of 49,99,000. So total amount is that you have to pay after 30 days back to the bank. This original borrowing that you made, which is 63.15 crores plus 49 lakhs. So you have to pay 63 crores, 64 lakhs, 99,000. Now, same logic when you come for 90 days direct trade from supplier, you have 1 crore USD and 30 days interest at 7.75%. So 1 crore into 7.75%, 30 days interest works to 64,000 USD. So when you have to repay the supplier, you will repay 1 crore USD plus 64,000, which is 1 crore 64,000 USD. And you repay at what rate? You repay the 90th day rate, which is 63.45. So you multiply by 63.45, you get 63 crores 85 lakhs 97,000. So this is 63 crores 85 lakhs. This is 63 crores 64 lakhs. So what is the best option? Pay the supplier in 60 days and take bank loan for 30 days, as the total outflow in that case is less than 90 days supplier credit. So it is much, much better and easier if you borrow from supplier after 30, if you borrow from bank after 60 days. Right. So this is question 42. Then we have 46 and 59. This is also a very similar question. I don't think we should do this. Let's move to 59. Currency futures. This is a currency futures question, 59. And 63 is what? Another question. Let's look at 59. Guys, give me 2 minutes break now. I need to stretch. Sorry, guys, I'm back. I had to stretch. Legs were paining with continuous sitting. So sorry about that. But okay, coming back. Let us look at this question. This is question number 59. JKL is an export business house. The company prepares invoice in customers' currency. Its debtors of US dollars 20 million is due on 1st April 17. Market information on 1st January says so and so. Right. So basically, export house, it has some money to be received on 1st April. We are on 1st Jan, 3 months in advance. Exchange rate, spot, USD INR. See here. Here they have given US dollars per INR. That is number of US dollars you will get for 1 INR. Okay. Very weird and ulta way. Okay. And 1 month forward, 3 month forward. Then currency futures. Contract size is this much. They've given some contract size. And 1 month for future, 3 month future. Okay. Then initial margin and interest rates also they've given. What is the initial margin for 1 month and interest rates in India for 1 month and 3 months also given. On 1st April 2017, the spot rate is 0.016136 and the currency future rate is 0.016134. Where is this? On 1st April. Achha, this is on 1st Jan. This is on 1/4. Okay, which of the following methods would be most advantageous to JKL? So you have to now see whether currency futures would be better or currency forward is better or directly take a spot, which is forward is better, future is better, or directly take a spot, which is on last day, which is basically not hedging. So you have to look at all three alternatives. Very interesting question. Okay, now let us see. It is $20,000, right? Have they given bid ask? Thankfully, they have not given bid ask. So you can directly divide, multiply, whatever you want to do. So this is the number of USD per INR. So what happens is you have 20 million, right? 20 million. That is 20 million is 2 crores. 20 million is 2 crores. Yeah, which is 200 lakhs. So you have a 200 lakh dollars after 3 months. So how much is it in INR terms? You have to simply divide it. So current value, total inflow using a forward contract. Forward contract for how much? For 3 months. 3 months is this. Right, this is a 3 month forward. So you divide by 0.016129. 0.016129, you get this many rupees. If no hedging is done, you get as per what rate? You get as per this rate. Where is this? This rate 16136. You get by 16136, you get 123.94, 64, 551. So basically, you're getting 123 crores, 94 lakhs. Here, you're getting 124 crores, whatever. Now, using currency futures. So one we saw forward, other one we saw no hedging. Now, currency futures. INR receivable after 3 months, the rate is 0.016118. What is this? This is a 3-month future contract as on today, right? So how many contracts? What is the minimum contract size? Contract size is 31. 31 lakhs is the contract size. Each contract has 31 lakh. It is not 31 lakhs. I think it is 3 crores. 3 crores, 10 lakhs, 21,000. So each contract is 3 crores. So each contract is for 3 crore rupees. So 3 crore rupees into, so you see 3 CR rupees into USD per rupee. What will happen? Rupee will get cancelled. You get, let this number is 0.1016. So you will get 3 crore by this in USD terms. So in USD terms, it is $500,000. The 3 crore number, when you convert it into the number of units of dollars, you get $500,000. So each lot is 3 crore rupees. Then the contracts, how many contracts would you require? You have $20 million. Each contract is 500,000. So you require 40 contracts. You are required to enter into 40 contracts. That is why this number is given. You first have to convert this 3 crore into equivalent dollars, which will give you lot size in dollar terms. You have total amount to be hedged is 20 million. Divide by the lot size, you get the number of lots. So 40 lots of futures contracts have to be entered into, each lot being for 3 crores rupees. Now, initial margin, you put as how much? You put initial margin of 50,000 and interest rate for 3-month period is 8%. So on 50%, 8% for 40 contracts, right? So for 40 contracts into 50,000 is 20 lakhs. On this 20 lakhs, 8% for 3 months will give you 40,000 rupees. So this 40,000 rupees is an additional cost. You're supposed to compute the cost. That is why this data is given. Then what? On the due date, which is 1st April, when you buy a future, you purchase the future at this. You sell the future at this rate. This is the same 3-month future. This is the settlement rate. Okay, this is the purchase rate. So what you do is you settle the original, whatever you purchased. Purchase was what? 16118 and settling it at 134. So you subtract those two, multiply with 40 lots, each lot size, you get this many USD. This is the gain that you will make from your future contract. Why is it a gain? Because you are buying 1 rupee at 1.16118 USD, but that 1 rupee has depreciated to 1.016134. So instead of 118, the rupee has depreciated. Dollar has depreciated. So for $1 is equal to, 1 rupee is equal to this many dollars. Here, 1 rupee to this many dollars. So you are now getting more dollars for 1 rupee. So basically, dollar has depreciated, not rupee, my bad. Okay, so you're getting more dollars for single rupee. So how many dollars do you get? You got this many dollars extra, which is $19,000 extra. $19,000 extra you got, but you have to make a payment. Payment is what? $20 million. $20 million, you will make a payment on that day spot. That day spot is how much? You already have that day spot here, where? Here. Right. So you convert this 20 million into spot at this rate. You will get 123 crores as payment that you're supposed to make, but you also made a gain. So the gain also, whatever is in dollar terms, you'll convert it into rupees and you'll get a gain of 12,30,000. So your net payment is whatever is the outflow minus the inflow, outflow minus inflow, net cash flow from this contract is outflow minus, this is what is the exporter or importer, exporter. So this is both inflows only. My bad, my bad. Both of them are inflows. This is an export transaction, right? So you are going to get inflow from your whoever is the importer because you're an exporter. You're going to get an inflow from which is basically this transaction, and there's an outflow of 40,000 which you have made for exchange margin, interest loss on exchange margin. So your net cash flow is 124. Now, what is happening in case of a forward contract? You got 124.00. In case of no hedging, you got 123.94. In case of currency futures, you got this. So because you're an exporter and you're receiving money inwards, max more money is better for you. So it is better to get 124 crores through currency futures. So hence comparing the above three, future contract is better. Hence it is advised to hedge using futures. So you have to very, very clearly remember they are saying you're an export business, so you're getting the money, right? So that is what was the small point that I missed out initially. Okay, this is done. 59 is done. Then let us go to 63. So my suggestion, guys, I think we should break for lunch. It's 12:55. So just give me one sec. I think we should break for lunch because I'm also actually hungry. We'll probably take a 40-45 minutes break and then we'll gather again. So I'll put a timer on the screen. Uh, Timer online. I'll put a 45-minute timer. Okay. And I will share my screen. Okay, guys. So we'll get back. We'll get back in 45 minutes. I'll come back. I think time is just around 12:01. So we'll be back at 1:45 and then we'll resume the class. Okay. So till then, I'll be on mute. And here is the timer. Okay. Chalo, catch you after 44 minutes. As the timer reaches 0, then we'll catch up again. Chalo, see you. Okay, guys, we are back. Hope you had good lunch. So there's somebody called Bhargav who's asking IFM derivatives and mutual funds. Derivatives is the next chapter after this. Mutual funds, let us see, we'll either do tomorrow or sometime next week. Initially I planned for 2 days, but going by the way in which the first Forex chapter itself is taken, I think it'll take more than 2 days. But today's session is on, and today we'll finish derivatives and a couple of more topics as possible. Then tomorrow we'll again pick up and try and cover another 4 or 5 topics, and probably, hopefully, in last day we'll schedule sometime early next week. We'll cover balanced topics. Okay, so let us get back. Let us start off where we left. I think we left at this question number 63, which is ZAS PLC, a UK company, is in the process of negotiating an order amounting to 2.8 million with a large German retailer on 6 months credit. If successful, this will be the first time they have exported into a highly competitive German market. They're considering following 3 alternatives for managing transaction risk before order is finalized. Mr. Peter, the marketing head, so they want to make a sale uh, for 2.8 million. They are based in UK. The people whom they're expecting to exporting to is based in Germany, are based in Germany. There are 3 ways in which they want to invoice. Peter, the marketing head, has suggested that in order to remove the transaction is completely, they should invoice a German firm sterling using the current average spot rate of euro to pound to calculate the invoice amount. Mr. Wilson, who's the CEO, is doubtful about Mr. proposal and suggested an alternative of invoicing the firm in euro and using forward exchange contract to hedge the risk. So please note, guys, these Jazz is UK company, so it is best for them if everything is done in pounds. But the German market is in euro. So one person is suggesting invoice in pound, one person is suggesting invoicing it in euro, and you yourself hedge the exchange risk. And third person is suggesting that invoice in euro, but instead of using the futures contract, sufficient they should use futures contract. So Mr. Wilson said this is invoice in pound. This is euro forward. This is euro futures. Okay, 3 people have 3 suggestions. Following data is available. You're required to calculate to the nearest pound the pound receipt for Jazz under each of the 3 proposals. So, which is the most beneficial? Then, in your opinion, which alternative do you consider most appropriate? So, obviously, when you see whichever is most beneficial, you will consider that. Now, first thing is we'll invoice it in pounds. And they said using the current average euro pound spot rate. Now, what is euro pound spot rate? 11960, 11970. So one way to look at this, you take the average of this 1.1965. That is one way. But I think that also is a fair assumption. But I think when they say spot average spot, probably this refers to the spot rate itself, because that is the current rate that is getting quoted in the market. We will take it using one current spot rate. You can also try using this 1.965, 1.1965. That also should give you a very, very close answer. Okay, so what is the rate applicable for us? We take 1.1970 because when we are invoicing in pounds, you're going to actually get the pounds per when you're basically selling euros. So what is the quote here? Euro 1.19 or 1.197 per pound. Right. So when in this pound thing, I've considered here 1.1970. You can consider 1.1965 also. Okay. It will not give you a different answer. Okay. Then largely different answer. It will give you a very similar answer. Okay. So now the thing is, what is the order size? 2.8 million. What is the GBP that you're going to invoice? So you're going to get euro, and euro, what is the value of the order? 2.8 million. That has to be converted into GBP. You convert it on which rate? You convert it on the rate that you've assumed, 1.1965 or 1.1970. You get this many GBP. So you get lower number of GBP, because why I took was bid ask. Ask is sell, and they are basically buying. So this is a GBP euro rate, right? So 1 GBP is equal to so many euros. So they're basically buying GBP. So, so I've considered 1.1970, ignore that. You get this many GBP, which is 2.33 million. Now, what is a forward contract? Original contract, if you do a forward contract, 6 months forward points is based on this. Okay, so you'll have 11960, 11970 plus 60 cents and plus 55 cents. So you add 60 and you add 55, you get certain values. Now, please note, this is not a forward premium, this is a forward discount. Why is it a discount? Because the forward point bid ask spread is actually the bid ask is lower than the bid. Ideally, ask should be higher than the bid. So it is discount. So you subtract. Where do you subtract? You subtract here and you arrive at the forward rates. Now, what happens to these forward rates? You are entering into a forward contract. What is a forward contract you are entering into? You are invoicing them in euro. So you are going to get the money in euro. That euro, you have to sell it to somebody, to the banker. When you are selling euro to the banker and the quote is GBP by euro and GBP is the base currency, okay, then bid by ask. Bid is buying GBP, ask is buying euro. Right. So you're going to get euro money. So that euro money you have to, sell. So when you're selling euro, the banker is, when you're selling euro, the banker is buying the euro and banker is selling you GBP. Banker is selling you GBP because the GBP is the base currency and ask quote is for selling base currency, which is GBP. So this quote is relevant. So you convert this, 2.8 million, whatever you get into 1.1915, because 2.8 million is in euro terms, you reduce it and it comes down to 2.34979. Okay, then you come to futures contract. What is futures contract? 6 months future contract is 1.1943. There is again no bid ask given. Contract size is this much. And 6 months spot rate and future, after 6 months spot rate and future net. Why is this rate given? Because the contract will not exactly meet, the lots will not exactly account for the full value of the contract. So let's take futures contract, 2.8 million GBP is number of euros. Please note, futures contract is for pounds. Okay. So you convert this you convert this euro into GBP, right? How will you convert into euro into GBP? Because you have the future rate. So you use that and convert into GBP. And how many GBP lots are required? Each lot is 62,500. So you get 37.51 lots. So 37 lots you will do through futures, which is 37 into 62,500, which is 2.3 million. And this 2.3 million, you will settle at which rate? They've already given the rate here, 1.1873. So you will settle it at 1.1873 versus original contract rate. So the difference between those two is your profit. What has happened to this rate? The GBP euro per GBP, earlier you were getting 1.1943 euro. Now when you originally entered, the rate has fallen. So you get basically the rate has fallen means it's a loss. So you're getting lesser euro. Right. So now you're going to get loss of 0.0070. So you multiply this GBP by euro rate. So number of GBP by euro into euro, when you do euro get cancelled, you get a value in GBP. GBP, this is what number of GBP, this is number of euro. Sorry, this rate is ulta, my bad. This is number of GBP into euros per GBP. Right, this GBP euro is number of euros per GBP. So GBP get cancelled, you get the answer in euro terms. Right, so euros, you will get 16, this is the loss. This loss, again, you convert it into GBP on spot terms. What is the spot rate? Spot rate is here, given here. Where is it? 1.1873. So you convert it in that spot rate, you get some GBP as the total loss. And you also, this is the total loss. Now, what is the amount that you have realized in spot? This is the actual loss that you will make on the contract. right, this is the loss that you made on the futures contract. But the future is, when you enter into a future contract, you have a separate contract for futures that is net cash settled. And the original transaction, you will continue to do it on spot. So what is the spot value? 2.8 by 1.1873, you get some GBP. To this GBP, if it is a loss, this is the inflow. From this inflow, you subtract the loss that you have. So you get 2344658. So what has happened here? In first case, you got 2349. You got more money. Then in second case, you got 2344. Then in one case, 2339. So where have you got maximum money? You've got maximum money in a forward contract. So that is the answer. On comparing 1, 2, and 3, option 2, which is forward contract, is the best option because you're an exporter and you have received maximum money there. Right. So this is illustration 63. Let's move to 75. An American firm is under obligation to pay interest of Canadian dollar 10140 and Canadian dollar 705,000 on 31st July and 30th September respectively. Right. Now, firm is risk averse and its policy is to hedge the risks involved in all Forex transactions. Finance manager of the firm is thinking of hedging the risk considering two methods, that is fixed forward or option contract. Right. It is now June 30th. Following quotations regarding rates of exchange of US dollar per Canadian dollar are available. Spot 1 month forward, 3 month forward. Now, this is number of US dollars per Canadian dollar. So one CAD will get you 0.9284 USD. So USD is stronger. Right. So the quote is CAD USD. So for 1 Canadian dollar, how many US dollars? Right. Price for USD can option on a US stock exchange, that is cents per Canadian dollar payable on purchase of option contracts with the size of 50,000 Canadian dollars as follows. Number of US dollars per Canadian dollar. Right. Here, you see the thing, 93 cents, 94 cents, 95 cents. Right. And this is the strike price. This is the strike price. 93, 94, 95 are the strike price. I have a right to buy 1 Canadian dollar per 1 Canadian dollar at 93 US dollar, 0.93 US dollars or 0.94 US dollars or 0.95 US dollars. And for that, this is the call premium. This is the put premium that I have to pay. This premium is in Canadian dollars. Cents per Canadian dollar. This premium is in. And this premium, I think, is in Canadian dollar only. Let us read the balance thing and then we'll see. According to the suggestion of the finance manager, if options are used, 1 month option should be brought at a strike price of 94 cents and 3 month option at a strike price of 95 cents. And for the remainder uncovered by options, the firm would bear the risk itself. For this, it would use forward rate as the best estimate of spot. Transaction costs are ignored. Recommend which of the above two methods would be appropriate for the American firm to hedge in foreign exchange risk. So this particular thing is a foreign company. This is an American company. These premium, please note, whenever you're looking at options, if I'm entering into an option in India, I will pay the option premium in rupees. So these are US dollar. This is number of cents of US dollar to get one US dollar, one Canadian dollar, how many US dollars will I get? This is the strike price, but this premium, right? This premium, these are Canadian dollars, but these are US dollars. Okay, please note that. Sorry, these are also US dollars. These are 1 Canadian dollar. For 1 Canadian dollar, how many US? So I'm sorry, 0.93. All both this as well as this are in US dollar terms. So now 1 month option should be bought at a strike price of 94. So let me clean this up. One month option should be bought. So what do you want to do? Do you want to buy Canadian dollars? Do you want to sell Canadian dollars? You are an US company, so you need to buy Canadian dollars. If you have to buy Canadian dollars, if the quote is CAD USD, bid is to buy for bank 1 Canadian dollar, right? In this case, when the options are given, your thing is you want to buy. right? You want to buy a Canadian dollar. You want to buy a Canadian dollar, right? So when you are buying, the bank is basically selling. Now, if you look at it here, this is the number of US dollars you get per Canadian dollar. So if you want to buy it at 90.93, you have to pay 1.56 US dollars. So 1.56, this is in cents or this is directly the thing? This is cents per Canadian dollar. So this is 1.56 cents per Canadian dollar. So if you see, they are saying that strike price of 94 cents is required. Now, the reason why I'm discussing this is, do you have to enter into a call or a put? The answer is simple. When they have said 94 and put there is no value, it actually means you have to do call. And call also because you want to buy, you have to buy Canadian dollars. So when you're buying a Canadian dollar, the quotes here given are per Canadian dollar, how many US dollars will you get? Right. So you want to buy an option to buy 1 Canadian dollar at 0.93 or 0.94 or 0.95 US dollars. So that is the important thing. And a 3-month option at a strike price of 95. So 3-month option at a strike price of 95. So 1 month is at 94 and 3-month is at 95. So what basically they are saying is, you have to do this and this. If you're trying to, so for this 101, this 1.02 is required. For 75,000, 1.64 is required. That is what they're basically saying. Right. Now, for the remainder uncovered by the options, firm would bear the risk itself. So basically, wherever you're not able to cover by options, you'll bear the risk by taking it on spot. Right. Transaction costs are ignored. I recommend which other method should be used. Now, question is what? Yes, hedging using 1 month and 3-month forward. Why forward? Because they've given the forward rates also. Thinking of hedging, considering 2 methods, fixed forward or option contracts. So either option or forward, which is where you have to evaluate both. Now, using forward contract, you have to pay 1,010,000 CAD in 1 month and 705,000 CAD in 3 months. So for 1 USD, what is the forward rate? Forward rate is 9301 and 9356, right? So you divide, you multiply it with this so that you get the number of USD that are required. So for 939,401 USD, if you give, you will get more dollars. Why? Because more Canadian dollars. Why? Because US dollar is stronger than Canadian dollar. So you have to give lesser US dollars to get more Canadian dollars. Same way you multiply here, you get 659. Now you have to compare this with the option. What happens in option? Option is, your total exposure is 101 and 705. I'm ignoring the thousands for now. And lot size is 50-50. They only have said here somewhere 50,000, 50,000. Yes. Right. So you need 20 lots here and you need 14 lots here. Okay. There is a small rounding off, which we will see later. So hedge portion is 1 million and unhedged portion is 10,000. Hedge portion is 7 lakh and unhedged is 5,000. So call option strike is 0.94. So first one I said 1.02 and 1.64. Right. So amount payable on option exercise in USD. So if you were to exercise this option, that is, you were to buy this one particular option and exercise it. Why would you exercise this option? Because you believe that in the future, the rates may slightly go up, right? So if you were to exercise this option, you'll have to pay 9.4 lakhs in USD, and you also have to pay premia. So the total premia that you would have paid is this, and unhedged exposure, you will do it at spot. Where is it? You'll do it at forward. So the total rate that you'll pay is 959,501. So 959,501 versus 939,401. How am I getting 959? One is using the option, then option ka premia, unhedged portion that is not hedged from option, you get forward rate. Same logic you apply here. You take, option premia, the rate at which you have the option strike prices, which is 95 cents. So it is 95 cents, whereas the 3-month forward is at 93.56. Right. So you will get a value of 700,000 into the premia plus 700,000 into 95 cents plus your 500 5,000, which is unhedged, is at the spot, you will get total value of 681. So now you compare forward and option. What is going to happen? It is very, very clear that forward is better, much, much better than option. A better question would have been that they give you actual spot in the market on that day, and whether you choose to exercise the option or not, and then based on that, what is the overall cost? That would have been a much better solution. But nevertheless, this is also fine. And here, one more thing, we can actually consider the future value of this premia paid, because premia is paid at the beginning, and the amount payable on exercise of the option is paid towards the end, right? So there is a slight timing mismatch, but they have not given interest rate, so we'll ignore that for the moment. Right, this is question number 75. Then coming to question number 76. After this, we'll be moving to fate of forward contracts, which is the critical one, which a lot of people have, doubts, questions, and all of that. Right. Or I think there is one more question after that we'll go. Now, A Limited of UK has imported some chemical worth 364,897 from one of the US suppliers. The amount is payable in 6 months. Relevant spot and forward rates are given. Borrowing rates in UK and US are 6% and 7% respectively, and deposit rates are 5.5 and 4.5. Please note, borrowing rates and deposit rates are given. These hopefully they are per annum. Currency options are available under one option contract is for 12,500 pounds. Just a second, guys. I'll drink some water. And the option premium is also given. USD 1.70 per pound. If you want a strike price of 1.70 USD per pound, then the option premium is 37 US dollars 0.037 or 3.7 cents. And the put option is 9.6 cents for 6 months. Now we have to figure out whether it is call or put. Anyway, the company has three choices: forward cover, money market, currency option, whichever is better. Let us see. Forward cover. 367, 847 is the USD that you have to pay, and 6-month forward rate. What are you doing? You need to buy dollars. So if you have to buy dollars, and this rate is number of, this is GBP USD. That is for 1 GBP, how many USD? So when you do a bid, ask, bid means banker buying GBP. Ask is banker selling GBP. For you want to buy dollars. So banker buys GBP and sell dollars. So for you, the bid rate is relevant. So this rate is relevant. Right. So spot may that rate and forward may this rate. Both of them bid rates are relevant for you for spot and forward. So your exposure is 364,897 in dollar terms. Exchange rate is the applicable rate is bid. So 1.5455, if you divide, you will get GBP of 236,102. Okay. Then money market. What is this money market? Money market is basically you, instead of directly entering into a forward contract, you basically buy now itself and then put it in some sort of a deposit. So what are you going to do? You basically have to borrow some GDP. How much GBP? How much GBP do you have to borrow? I will tell you. First, you have to convert. You have to first work from bottom. What is bottom? Bottom is you need 364,897 GBP, 364,897 USD in your hands. If you require 364,897 USD, you have to put some deposit. 4.5% is per annum, so 2.25% is for 6 months. This is 6 months only, right? Yes. So at what rate? I think I would have given a working note somewhere. Okay. So if the deposit plus interest at 2.25% is equal to 364,897. So what is deposit? You have to work backwards and find it. So you will arrive that you need to borrow, or you need to place a deposit of 356,867. If you have to place a deposit, you don't have USD money, then you need to convert it right away from pounds. So if you have to convert it into pounds, what is the pound USD current exchange rate? 15167. Please remember, I told you you have to use the bid rate. So you use the bid rate and you convert the pounds, but you don't have pounds also. So you borrow pounds. So you borrow pounds at 7%. How much do you borrow? Same number, 228,512. So you're borrowing 228,512. Okay. Then moment, you borrow, you put it into GBP, you borrow pounds, convert it into USD, you place a deposit money comes back on the due date. On the due date, you get USD and you repay the GBP loan with interest. Why will you repay the GBP loan with interest? Because you have originally borrowed, right? So you have originally borrowed, right? So that amount that you repay isn't basically exchange. So you've got now $364,897, and you are now repaying a loan which basically is in pounds, right? So this is in pounds. This is in dollars. You have a deposit in dollars, you have a repayment in pounds. So these both are exchange. Basically, the whatever dollars you wanted, you have whatever money you have to pay out in pound terms, you have paid out. So you repay this 236,510. So what happens? Money in a forward cover, you are paying only 236,102, whereas here you are paying 236,510. So you are paying more. So forward is much better than your money market hedge. Now come to currency option. What is currency option? It is a currency option. Currency option. Strike price is 1.7 and 0.36. So one lot in USD equivalent is how much? 12,500 into 1.7, which is 21,250 USD. 12,500 GBP lot size. Equivalent USD lot size is this much. So what is your overall exposure? 364,897. So how many lots do you require? 364,897 divided by 21,250. So you require approximately 71 lots. So how much is hedged exposure? 21,250 into 17, or which is equal to 212,500. How did I get 212,500? Because I use the same rate, same exchange rate, whatever I've used here, 1.250, no? Same exchange rate. What is it? 1.70. I'm sorry, not 1.250. 1.70. So I get it in GBP terms. So amount unhedged is the difference between these two, right? Whatever is hedged versus whatever is the total exposure. So for a strike price of 1.7, base currency, so put option has to be entered, sell GBP and buy. So if it's an option for GBP, you'll have to enter into a put option because you have to sell GBP and buy dollar. You cannot consider call option. You should consider put option. So put premium is how much? 0.096 for selling 1 GBP. So how much will you get? You have 2,12,500 as a hedged exposure. On that hedged exposure, you pay a premium of 0.096. So your premium is 20,400, right? And the spot rate is 1.5617. Why is the spot rate relevant? Because unhedged exposure is used for that. No, spot rate is used for converting the premium paid in on day zero. Okay, for premium paid on day zero. What is the day zero paid? 20,400. You convert that particular amount that you have paid in USD into GBP terms, which is 13,000 GBP. Unhedged portion is 3647, which is what you have found out here. That also you convert it into USD on the spot rate on the closing date. They've given a closing date spot rate. No, where is it? Or you can take a forward rate. You can take a forward rate, which is 1.15455. That's what they've done, right? Yeah. You convert it into spot rate, forward rate on the after 6 months. So you'll basically get a GBP value of 2359. So these are all you're basically spending this much money, you're spending this much money, then you're also getting it for this much money. The USD 361,250 for GBP 212,500. Now you see what is the total value of the outflows that you have? You have paid, for getting so much USD, 364,897 USD, you had to pay 212,500 GBP. Then interest paid, whatever is the premium paid on that interest. Then you sum up all these three: premium plus GBP unhedged portion plus GBP hedge portion plus interest on the premium that has been paid in the beginning. So all four of them, if you add, you get 228,379.63. So if you look at this, which is better? This is 228,379. This is 236, and this is 228,512. So option is marginally better than forward cover. So you say on comparing three ways, currency option is the cheapest as compared to forward market and money market. Right? Okay. Now moving forward, let us look at next aspect, which is Nostro, Voro, and Loro. Just give me a minute's break, no? I'll just come back. I need to stretch again. Neck is aching, so I just need to stretch. Give me a minute. I'm back. Just went out to stretch. Now, coming back to our thing, we had to discuss, next question is on Nostro, Voro, and Nostro, Vostro, and Loro. So before we get into that, I want to actually explain what those are and then move forward. So what are Nostro, Vostro, and Loro? Interbank transaction, foreign exchange is transferred from one account to another. So basically, banks in India there is SBI. In US there's a, let's say, a Bank of New York, or JP Morgan, or somebody. So when you or I need to make a payment to any other person in US, we give the money to SBI. SBI will have an account in JP Morgan in USA. That account is called SBI's Nostro with JP Morgan. Then JP Morgan will have an account with SBI. Ulta. That account is called, by SBI, it is called as Vostro. Right? Nostro is my account with you, Vostro is your account with me. So Nostro and Vostro will become Ulta when JP Morgan talks. So JP Morgan will, when JP Morgan's account with SBI is Nostro for JP Morgan, whereas it is Vostro for SBI. Right. So you have three accounts, Nostro, Vostro, and Loro. Now, the thing is, with respect to our syllabus, we are not, it is not covered in full depth, but basically we are supposed to create an account balance, exchange position, and give details of Nostro or Vostro account, whatever transactions are there. We are supposed to make entry. This, I don't know why they've kept it as part of syllabus. It is, I don't think it is essential for us to understand anyway. But they have asked this one, so I wanted to actually show you guys this and then solve that question particularly relating to this. So I am solving this question. Question number is 76 we have already done, and question number is 80. Yeah, so I'll solve question number 80 so that you get an idea of what is it that we are talking about. And in this, we are not going to look at Nostro Vostro, we're just going to look at a exchange position. What is this exchange position? Now you see the question. You as a Forex dealer have dealing position in your account in London. So you are India, you have an account in London. Right. Opening balance is oversold. Mean you already have, you're short. Basically, you're short. Right. So if it is London, it is pounds, right? So you oversold means that is the opening balance oversold. You have to create an account like this. Now, how, why, when, what, where, please don't get into those discussions. This is a small topic as part of our ICA material. I really don't think it should even be there, but nevertheless, it is important for exams I'm teaching you. So opening balance, if it is oversold, you'll put here. If it is overbought, you'll put it here. Right. Then purchase of checks not yet credited. So if purchases of checks is not yet credited, you have actually basically purchased. If it is already credited, it will reflect in your bank account, but it is not yet reflecting. So you put this as 164,000 as something that is not yet reflecting. Then outstanding forward contracts. See, forward contracts, outstanding forward contracts, you have sold. So there are some sale of forward contracts. So basically you have sold the GBP. So here you write sales of GBP. Then purchases, you write purchases here. This is just like a debit credit kind of a memoranda account only. Then DD is issued but not yet presented. So basically you have issued but not presented. Basically it's some sort of a sale that has happened for, you have basically sold the GBP but entry has not been made. So, or not yet been presented. So you write that 6 lakh here. BBB bills purchased in hand not due for. So you have purchased. So exactly like DD's, bill is opposite. So you have purchased but not yet due. So you total all the GBP purchased, you total all the GBP sold, you get a total. 5.25 million is GBP purchased and 4.89 million is GBP sold. So what is the current position? You have to current position is 3.364,000 GBP overbought. You have to overbought. What should you do to square off? Because that's the question, no? What must you do to square off your position? You should sell. So if 364,280, in order to square his position, one has to sell GBP of 364,280. It is just a summation of all the numbers. You have to figure out which is debit side, which is credit side, which is purchase, which is sold, and then figure out what is the position. It is a very simple thing. I think there are one or two more questions also where so in one question, they've given the Nostro account. Now, please note, when you compare a question like this with the previous question with the current question, what is the difference? I'll tell you. Balance in Nostro account is not part of exchange question. So it doesn't come in exchange. So you see, balance in Nostro is here. It is not there in exchange. This is question number 81. Opening balance over part, this comes to your CHF purchased. It doesn't come in your Nostro. Purchased a bill on Zurich. So if you're on Zurich, it basically means that there is some purchase of exchange. Okay. Nostrum, what comes is when there are remittances only. Okay. Then sold forward TT. TT is sold forward TT is where you basically have sold the thing. Right. Forward, again, it is not spot. Okay. So CHF sold is 60,000. Forward purchase contract cancelled. So this is reversal of so forward purchase contract cancel. Purchase will come here, cancellation will come here. Then for remitted by TD. So this is an actual remittance. So this will only come in Nostro. So in Nostro, you will have a remittance of TT. So if TT remittance is here and TT received is, it will come on the other side. Right. Then what are they saying? Draft on Zurich cancelled is 30,000. So this you'll have a Zurich which is cancelled. What steps should you take if you're required to maintain trade balance of 30,000 in the Nostro account? So if the balance has to be 30,000, what should you do? You should make some purchases and keep overbought position on Swiss francs of 10,000. So if you're what is the balance of exchange position? Exchange position, you purchased 5,000 here. So that 5,000 will also come as CHF purchase. So if you look at the overall balance has become nil. But you have to keep an overbought position in exchange account of Swiss francs 10,000. So you have to purchase additional 10,000 Swiss francs in either in forward or whatever, so that the exchange balance is 10,000. So this is a fairly simple logic. There is nothing much complicated to it. Just that only actual remittances of TT come into Nostro or everything else goes into exchange account. In that, you have to figure out which is on purchase side, which is on sale side, and move forward. Okay, this is 80, 81. Now let us come to 87, 88. What are 87, 88? 87, 88 are fate of forward contracts. So before we get into fate of forward contracts, I want to discuss about fate of forward contract. What is it that is available here? So when you have a forward contract, right, you are entering into a forward contract to make a purchase or a sale. You're entering into a forward contract in order to ensure that you either purchase dollars or you sell dollars, whichever way it is. Now, when you do this, on the due date, if the transaction is successful, that is, let's say you're importing something and you have to make payment to the importer, then you will say, I'll buy dollars from the bank. On the due date, let's say importer says, please pay me, please pay, you have some cash problems and you ask the importer, can I delay the payment by a month? The importer agrees. Then what will you do? You will have to come to the bank and say, oh, there is a payment that is getting delayed. So please extend my contract. So that is called as extension. You can also say, on the due date, no, importer is asking me money, so I will honor my contract with the forward contract with the bank. So you'll ask for delivery of the currency, or you can say the importer, the particular payment that I have to make, I don't want to make that payment now for whatever reason. I'm canceling the contract, so you can have a cancellation of the contract as well. So a forward contract can either be delivered on due date, it can be cancelled, or it can be extended. Now, is it only due date? No, it can be on due date, before due date, and after maturity up to 3 days. So if the contract is maturing on 31st of a month, till 3rd, you have time. You can do late delivery, late cancellation, or late extension. So all delivery, cancellation, extension, all three can be done before due date, on due date, or after due date up to 3 days. And if you do after 3 days, then it is automatic cancellation. So the bank will not listen to you. They will automatically cancel your contract. Now, what are the things to note? Things to note is this 3 days story I already told you. Huh. So the key thing is, key thing here to note, I will directly get into the mechanics of this. So when you have early action, which is a delivery, then you are seeking delivery of the forward contract. It may be a buy or sell. It doesn't matter whether you're buying dollars or selling dollars, right? The delivery of that particular forward contract, you're asking early. So you have two charges. One is called swap, one is called interest. What is swap? Swap is when there is a buy and sell of foreign exchange. One is for spot, one is for future due to customer action on or after the date of customer action. Right. Whereas if it is cancellation, cancellation means I'm fully canceling the contract. So please, whatever is the cancellation rate versus whatever is the booking rate, the difference between those two is called cancellation gain or loss. Whereas I want to do an extension, and all of these three, please note, I'm saying early action. I am doing all of these before due date. Before due date, if I do extension, then you will say I will cancel and I will book a new contract. So this is what it is: ED by C, which is exchange difference or cancellation gain loss plus a new contract. Whereas if I do anything on due date, what do I do on due date? On due date, I take delivery, obviously no impact. It is against the forward contract, the delivery happens. Whereas if I cancel, then I'll have cancellation gain loss. Whereas if I seek an extension, same logic. I will have cancellation gain loss plus there will be a new contract because it is on due date. And because it is on due date, there is no concept of interest. Whereas if there is up to 3 days after due date, there is a concept of interest in all three cases. So you'll have exchange difference plus interest plus swap. Why is there a swap? Because there is a flow of, you're doing a transaction in spot versus forward, one buy, one sell. So there'll be a swap charges. Interest because there is an outflow of funds, change in outflow of funds, and in case there is a delivery, it will be a new transaction. In case it's an extension also, it's a new transaction. In case of automatic cancellation, it is all three, which is ED, exchange gain difference or exchange difference, gain or loss, or plus interest plus swap. And please note, interest is not there if you do anything on due date. Interest is there if you do anything after due date. Interest is there if you do take delivery before due date. Why it is before due date also? Because there is a bank is being forced to move funds because of you. And beyond 3 days, obviously, there is interest. And there is no profit share. So in case there is a profit that arises out of this transaction, the bank has a choice not to give you the profit share if you do any transaction either after the due date within 3 days or completely after 3 days. Right. So swap charges. What are swap charges? Swap charges are applicable when bank is buying and selling for different time frame due to customer actions, one swap and one forward. That is what I was telling you. Flat charges, usually some charges are levied. This you should consider only if it is given in the question. Exchange difference is difference between initial rate and interbank rate entered into a bank due to customer cancellation. So it is the rate between the initial rate and interbank rate. And interest on funds, interest is applicable whenever there is inflow and outflow of funds for bank. And in case of post-maturity, so whenever there is inflow, outflow, that's what I was telling you. In case of post-maturity transaction, that is these two, banks back-to-back transaction rate will be considered. So banks back-to-back transaction rate will be considered. In other cases, that rate will be ignored. In case of early delivery, interest is not computed using back-to-back rate. So only for this back-to-back rate is considered. For this back-to-back rate is not considered. Some other thing is considered. What is considered, we will discuss. Right. What are the other points? New contract entered into in case of extension or cancellation and delivery. Right. FedEx guidelines ask you to round off to 0.0025 rupees. Okay, which is 0.25 paisa. Over and above the normal exchange margin, whenever interbank rates are given and bank has entered into one-side transaction due to cancellation from customer, exchange margin will be applicable. It will be on the last cancellation by the bank. So there is something called as margin, exchange margin, which will be applicable only on the last transaction, or which is last cancellation by the bank. It will not be applicable on anything else. Now, having understood this, let us go and see a problem. I know we discussed this quickly, but only when you have a broad understanding and you go back to my initial any of the questions, you will realize that you come back here, check, and then go ahead and solve the problem. Let us go and see. This is question number 87. Let us see. On 10th July, an importer entered into a forward contract with the bank for 550,000 due on 10th September, an exchange rate of 66.84. The bank covered its position in interbank market at 66.68. How would the bank react if the customer requested on 12th September to cancel the contract, to execute the contract, or extend the contract with revised due dates on 10th November? So they are coming back on 12th. Original contract is on 10th July for 10th September. So they are coming back after the due date, but within 3 days. And they're asking you to cancel, execute, or extend. So which one will apply here? This one will apply. This one will apply because they're coming after the due date, but within next 3 days. Right. So let us go back. Now, exchange rate interbank were 10 September and 12 September. Now, there's also one more concept of optionally deliverable forward contract. I will explain it as we move in this particular question. Now, importer entered into forward contract on June at the exchange rate of 66.84. So if it's an importer, they have to buy dollars. If they have to buy dollars, you'll charge higher. The bank will charge higher. So this is the applicable rate. Ask is the rate everywhere. Okay. For the customer. Okay. Now, exchange margin was 1% or 0.1% buying and selling. Interest and outlay was 12% per annum. You require to show calculations to cancel, execute, or extend the contract. Okay. Now, customer, they enter into a contract for 50,000 on 10th July at 66.84. Okay. You basically split the create a table with two parts, customer and bank. So when customer enters on 10th July to buy 50,000 at 66.84 with maturity of 10/9, bank agrees to enter into the transaction. But at the back end, bank also does a back-to-back transaction. So they with interbank go and cover. Now, did they say what they covered? Bank covered its position interbank 0.68. Bank has to sell to the customer. So bank will have to buy from interbank. So bank has agreed to buy $50,000 in interbank at 66.68. So it's a very important step because this is used for certain other things. We'll come to that. Now on 10/9, which is the due date for the contract, this guy didn't come back. So interbank the bank had to purchase. They had to purchase an interbank at what rate? 66.68. But what will they do with that? They don't have, the customer has not come back. So they will have to sell it off in the spot. What is the rate at which they will sell it off? On 10th September, they will sell. When they sell, they are the customer. Interbank is the bank. So they will be able to sell at 66.15 only. So they will sell it at 66.15. And because the customer can come back for any time in the next 3 days, they will enter into an optionally deliverable forward contract. The price of this optionally deliverable forward contract is spot over September. That is the last date of September. Whatever is the rate, that rate will be applicable. And they are buying. So why do they have to buy? Because they have to sell it back to the customer. So the rate applicable with 66.32. So they will buy $50,000 at 66.32. Now on 12th, if let's say the customer says, three things. One is cancellation, right? He comes and says, I want to cancel the contract. If you're going to cancel the contract, what the bank first does is, the bank does not directly cancel. Already it has been cancelled. They will, whatever they have purchased, whatever they've entered into a contract on forward contract for month-end maturity, because this is month-end maturity, they will honor that contract that day itself when the customer is asking. So they will buy. Then they will get dollars. The same dollars, they will sell it off in the market. What is the market rate? On 12th September, the market rate when they sell is 65.96. So the optionally deliverable contract, they will exercise that optionally deliverable forward contract and they will sell it off in the market at 65.96. So 65.96 is also not the direct rate. From that, you have to also subtract the margin. Why you have to subtract the margin? Because I told you over and above the normal exchange margin whenever interbank rates are given and a bank has entered into a one-sided transaction due to cancellation request from the customer, exchange margin will be applicable. It will be on the last cancellation by the bank. It is so clearly given, right? So this box, no, this box is very important for you to understand this. Now coming back. So you subtract 65.96 minus 0.1%, you will get 65.96 minus 0.01%. It will be 65.895 something. So you will take 69.8940, but you have to round it off to the nearest 25 paisa, nearest 0.25 paisa. So you will, it is 65.89404. This is closest to 8950. So you will round it off to 8950. You have to specifically say in the exam, you have rounded off. So now this is the issue. Now, in this case, what has happened? You have cancelled the contract. If you have cancelled the contract, what are the things that will happen? I told you. If you cancel the contract in next 3 days, you will have exchange gain loss, interest, and swap. All three elements will be there. So far, you've just found out the cancellation price. Please don't think this problem is solved. You have to find out swap, interest, and exchange difference. What is swap? Swap is buy and sell, forward and spot, on the date after which customer makes an intimation, or on the date on which customer is supposed to execute his end of the bargain. So after 10/9, right? What is one buy and one sell, which is one spot, one forward? You bought in interbank, you sold on spot. Optionally deliverable contract, you bought, you enter into a forward contract. So this is entering into a forward contract. Then you executed that particular contract, and then you sold on spot at 65.96. So here, the relevant thing is 66.15. Why is it 66.15? On that day, there is a spot transaction. So everywhere else, you have forward contract, honoring of the forward contract, and here you have a sale on spot, right? But this is the spot on the day when the customer is supposed to come. On that day, whatever is the transaction. So the transaction on the day the customer is supposed to honor, you have sold, right? On the same day, is there a forward contract which buy? Yes, you have a forward contract for buy. So these two, difference between this 66.15 and 66.32 is the swap gain or loss. So 66.32 you have bought, 66.15 you have sold. So the difference is 17 paisa. 17 paisa into 50,000 is 8,500. This is a swap, right? So what is the definition of swap? Swap charges are applicable when bank is buying and selling for different time frames due to customer actions. So on that day, customer did not respond. So because of that, we are having to do something, right? On 10th of September. Interest. What is interest? Interest is applicable on cash flows. There has to be a flow. There has to be forward transactions are not flows. Execution of forward transaction is a flow. So there has to be a flow which is caused because of the customer. So what is the flow which is caused because of the customer? First, one flow is you were having to buy from interbank at 50,000 at 66.68. Then you have sold it in the spot at 66.15. You're buying at 66.68 and selling it at 66.15. So that is there is a flow. So there is a spot sale and forward buy, right? You have execution. This is the honoring of forward buy, not actual forward buy, honoring. Right. So the difference is 66.68 minus 15. 66.15 is sell, 66.68 is buy. The difference between those two is 53 paisa. On this 53 paisa, 12% interest for 2 days. Why 2 days? Because you've come back after 2 days. Right. You're still within the 3-day period. You've come back after 2 days and asked for something. So 17 rupees. Then exchange difference. What is exchange difference? Exchange difference is the difference between what we discussed. Where is this? Cancellation price on the last day and the interbank rate. What is the interbank rate? And the agreed rate, I'm sorry. And the agreed rate. What is the agreed rate? 66.84. So 66.84 minus 65 or 66.84 and 65.59. 65.89. 65.89 is your cancellation rate. So cancellation rate versus original agreed rate. That is basically the cancellation, exchange gain, cancellation loss. That comes to 945.945 rupees, which is 47,000. So total loss is 47,000 plus 17 plus 8,500. So total loss is 56,750. Now, this is the case when customer asks for cancellation of the contract. If the customer asks for execution after 2 days, what will happen? Your entire cancellation gain loss, whatever you have computed here, right? Cancellation gain loss, where have you computed? Exchange difference gain loss, you have computed 47,250. This 47,250 customer has to bear. Right? Cancellation gain loss plus swap also. Why swap? This one. If you come after 3 days, whether you ask for delivery, whether you ask for cancellation, whether you ask for extension, in all three cases, exchange difference plus interest plus swap, all three have to be borne. Right? So that is why not only cancellation gain loss, even the swap and interest have to be borne. So not only this cancellation gain loss, even the swap and interest charges have to be borne, which comes to 55,767 plus you are buying, agreeing to buy new at the new rate. What is the new rate? On 12th September, what is the new rate applicable? 12th September, 12th September, new rate applicable for 10th November. Okay, so we don't have exactly the month end rates. We'll assume that this is the rate 66.40. Cancel execution. Oh, these ask for execution. I'm sorry, this is not extension. So execution is at this rate, 65.99. My bad, my bad. Is asked for execution. Customer asked for execution. I read the execution as extension. Okay, so 65.99 plus 0.1% margin. So you get 50,000 into 66.05. So your total outflow will be this much. Because you're executing the cash flow, you're paying off rupees, getting the dollars. Then extension. Extension is a different thing. Extension means cancellation gain loss plus extension with a new contract. Extension is here 66.49, which is what I was referring to. 66.49. Because we don't have, we're assuming that this is the November 12th date, not the November end date. Okay, so you will get 50,000 into 66.5575, which works to 33,83,642. Now, this is one way, one kind of a question in which all this, cancellation, gain, loss, everything is asked. Now, a similar kind of question was asked in recent exams. My strong suggestion, students, if you're very comfortable, solid, you remember everything, please solve these questions. If you have an opportunity to solve some other question, and leave this question in choice, I strongly suggest you leave this in choice. Why am I saying that? Because in this, there are a lot of computations and computations are confusing. You tend to forget and you tend to waste time. I know at least 3 students who have wasted 40, 50 minutes in this question, not got the answer. They got one part right, half part right, 2 parts right, but they did not get the full answer right. So my strong suggestion, don't try, and if you're getting it in one shot, do it. If you're not getting it, leave it and rather solve some other problem where you can actually score marks. If you're 100% confident of this, I am fully with you. If you are not, just ignore this part. So there are three topics I say usually for this. Three things that you don't need to, or most first important thing is that single index sharp model. There is one in portfolio management, which is a huge working. Okay. I always advise don't study. If it comes, leave it in choice and do something else, because trying to solve it, you'll waste too much time. Trying to remember it, you'll waste unnecessary energy. It's a huge thing. That is one. Second thing is fate of forward contract. Fate of forward contract is slightly lower order. If you're able to understand it and do it, okay. Third thing is questions on IFM, International Financial Management, where they ask about projection, then value, then all of that. There also, I always suggest don't do it, because there are way too many assumptions. If you have an opportunity, avoid that question. So these three questions, that single index chart model, though 100%, my strong suggestion, don't study. I don't even know why they've kept it in the exam. Even this fate of forward contracts is not a really relevant thing for a CA student. I don't know why they're overcomplicating life. Right. But that IFM is relevant for CA student, but they give very open-ended questions. So my strong suggestion, ignore sharp single index, fate of forward contract and IFM 50-50. If you know it, do it. If you don't know it, go for leave it in op choice and go and do something else. Otherwise, it is genuinely waste of energy, time, effort, resources. Okay, and it hits your confidence for other questions. If you want to do these questions, at least solve them in the end. Don't solve them in the beginning, because you'll first you'll try to get the correct answer. You'll waste a lot of time. Okay. Anyway, so this is question number 87. Let's go to 88. 88 is also a very similar question. I don't know why we should do this. 88 is also a very similar question. I don't see any difference between this and that. 88 is also a very similar question. I think actually we can ignore it. Rather, we should go and look at this question 98. 98 is a very interesting question. See, there are almost most of the solutions are given here. So you guys can go through if you want. Obviously, you can spend time. If I start spending time on each and every question and trying to explain everything, it is going to take away too much of energy of everybody, right? Because you will also get bored. I'm solving things that are already there, and there is no new thing that you are actually revising, right? So let us go to 98. This is a good question. This is the last question in this chapter. After this, what is the time now? We'll take a break. We'll take a 10-minute break, and then we'll come back and start with derivatives chapter. This is the last question in this particular chapter. Getting comfortable with foreign exchange rates, crosses, money market hedge, then futures, options, and fate of forward contract, and of course interest rate parity and arbitrage. We've solved all varieties of problems. I've solved some 17, 16 problems. Right. So this is the last question. This is an interesting question. Ms. Daksh is planning to import multi-purpose machine from USA at $15,000. The company can avail loans at 19%. Interest per annum with quarterly rest. Please note quarterly rest, which it can import the machine. However, there is an offer from New York branch of India-based bank extending credit of 180 days at 2% per annum against opening of an irrevocable LC. Right. So either you can take an LC and borrow against the LC, or you borrow. So there is this concept called buyer's credit and all that. They didn't explain it fully, but then they gave the question unfortunate. There's also concept called supplier's credit, where against the LC you can actually get borrowing. And they've or you can take a domestic borrowing. So this is basically domestic borrowing without LC, or international borrowing with LC. Spot rate is 75, 180 days forward rate is 77. Commission charges and LC is 2% for 12 months. Please note, commission charges are always paid upfront. Justify why the offer from foreign bank should be accepted. Based on the present market condition, company is not interested in taking the risk of currency fluctuation and wanted to hedge with additional expense of 30,000. So what is your advice to the company? Assume 360 days in a year. Okay. So what is the import cost? 15,000. Local borrowing is 19% with quarterly rest. 19 by 4, you'll get how much? 20 by 4 is 5. So this one you'll get 4.75. LC based borrowing is 2%. So here, please note, commission is 2%, and they also said there is an offer from New York-based branch extending credit of 180 days at 2% against LC. So this borrowing is against LC. Right. So LC commission is also 2, foreign borrowing rate is also 2%. And day tenor is 180 days, day convention is 360. So even the rupee borrowing you have to do for 180 days. Spot is 75, forward is 77. So I typically suggest that please write given data first in the solution. It makes life simpler. You don't have to keep flipping the question paper and all that. Cost of local borrowing. What is local borrowing? You have to pay 15,000. If you were to pay today itself, you will pay it at 75 rupees per dollar. So 15,000 into 75 is 11 lakh 25,000. 11 lakh 25,000 you have to borrow from bank. You have to borrow from bank for two quarters with quarterly interest rate at 19%. So the rate will be 11 lakh 25,000 into 1 plus 19 by 4, which is 4.75%, power 2. Power 2. This is the formula, if you guys remember. A is equal to P into 1 plus R by N power NT. T is rest. N is number of rests and T is number of periods. Right. So you'll have to repay 12 lakh 34,413 after 6-month period by doing this what 11 lakh 25 into 1.0475 power 2. Why 2? 2 quarters. 4.75%. Why? Because it is per annum but quarterly rest. Now, foreign currency borrowing, what will you do? This is the amount you will pay on a rupee. Now, for foreign currency borrowing, you'll have to open an LC. LC is opened at today's value. Today's value of the transaction of the shipment is 11 lakh 25. On that, 2% commission for 180 days. So commission itself is 11,250. Then there is this commission is paid upfront. Whereas this entire borrowing, you're repaying at the end of 180 days. So it is a forward rate, future value. Whereas this commission is present value. So you have to convert value, you again do 1.0475 power 2, you'll get 12,344. So 12,344 is the first outflow that you'll have with respect to LC if you open a foreign LC. Then interest. What is the interest? On $15,000, you have to pay 2% interest. Right. This 2%, this is in dollar terms. Okay, my bad. I think I don't know why it is. So piece, it is dollar. So this interest is in dollar terms, right? So when you repay, you have to repay 15,000 plus $150. So you basically, and you enter into a forward contract for making this repayment, right? So forward rate is 77. They've already given it. We have noted it down also here somewhere. Yes. So 77 into 15,150, you get 1166,550. This is the payment that you'll make at the end of the period. So this is A, this is B. One is LC commission, one is the payment of LC. Then you add both of them, that is the total outflow on your account, which is 11 lakh 78,894. Whereas what is it in case of local borrowing? 11 lakh 25,000. Right, you are paying 11 lakh 25 there. Here you are paying 11 lakh 78,000. Oh, my bad. It is not 11 lakh 25. 11 lakh 25 is the total value of the shipment. You are repaying 12 lakh 34,413. 12 lakh 34. Whereas here you are paying 11 lakh 78. So what is 12 lakh 34 minus 11 lakh 78? 34 plus 22 is 56, roughly about 56,000. So offer from foreign bank of Indian bank, foreign branch should be accepted as the overall cost of import is cheaper by 55 or 56,000, whatever number I put here, right? Now, what are they saying? Additional complication. Based on the present market condition, the company is not interested in taking the risk of currency fluctuation, wanted to hedge with an additional expense. So this 77 is forward rate, and they're saying that 77 is expected forward. I don't know what forward it is. There is an additional charge of 30,000. There's an additional charge. Your total buffer here is 56. So even if you remove 30, you still have 26,000. So even if the company incurs additional cost of 30 towards hedging the foreign currency borrowing, the foreign currency borrowing is cheaper by 25,000. Hence, the company should borrow in foreign currency even in this scenario. Right. So this is the answer. You have to write it properly. All these workings you have to make. Interest also you have to take. Upfront charges, anything paid, you have to take them at future value. Now, let us see if there is any other theory portion that is left in this particular chapter. Fate of forward. What is an NDF? NDF is non-deliverable forward. So these are basically done outside India and are cash settled. Okay, profit or loss is calculated upon exchange rate. They are quoted for time periods of 1 month to 1 year. They have a fixing date and settlement date. Fixing date is date which there's nothing much here. This is very simple. Then exposure management strategies. All of these you can read on your own because there is these are not anything new. These are all same. These are all, there is nothing new in this particular attempt that is important for you guys. Everything is as per same attempt. I have covered the things which are new, which are basically Swift and payment gateways. These are the two things that are new from this chapter, which you should be very careful about, because there is a potential to ask an MCQ as well as a theory question. We don't know how the question paper pattern will be, how many, so, they've given broadly the number of marks per chapter, but they've not given, post MCQs, how much will be in theory, how much will be practical and all of that. So you have to be prepared and ready for everything. Okay. So now that this is done, let us look at next move to the derivatives chapter. But before we move there, just one sec. I think we need to take a 10-minute break, because for me also head is aching and I also need a break. Right. So we'll be back after 10 minutes. Just hold on for 10 minutes. Okay, friends, welcome back. I hope I'm audible and visible. Just a sec. Just checking something. Okay. I guess I'm audible as well as visible. Okay, so let's proceed with the next aspect, which is derivative analysis and valuation. So this is the next chapter. Forex is usually typically a chapter that a lot of students have queries or doubts or confusion. Second chapter where they actually fumble quite a few times is derivatives, and Institute also has not been fair in the way they've been questioning, giving, see, twisted questions are okay, but giving questions which have no interpretation is not fair, especially November 23 exam. The questions that they asked on binomial model and risk neutral is very bad. They shouldn't be asking questions like that. But anyway, it is their infinite wisdom and knowledge. Who are we to question? Right. So just coming back, I hope everybody is able to see me, hear me. Can someone say I'm audible? I'm audible, right? Please confirm. Yeah, let's move forward. I'm not going to get into theory of what is derivative and all that you can figure out. But this chapter has seen a lot of changes, significant amount of changes in terms of new topics that have been added. Okay, so please be aware that quite a few new points have been added. Derivative is, a contract which derives its value from an underlying forward contract, futures contract. All of this, I presume, I'm not going to get into all of that. What is a derivative? What is a future forward? Difference between future and forward. One is one is over the counter, customized. The other one is standardized in an exchange. There is credit risk in a forward, futures, there's no credit risk, so on and so on. There are a bunch of points. All these you can read. I'm not going to revise all of those. Okay, what are options? You guys know. What is a call option? Call option is a right to buy. It has a payoff like this. What is a put option? Put option is a right to sell, which is a payoff like this. So as the price falls in a put option, you make money. As the price rises, you make money. As the price falls, you make money in a put option. Okay. Call and put will not get into that. Cash and derivative markets is basically buying in cash market. What versus derivative market? That is the thing. Instead of doing any derivative, if you were to buy in spot on a daily basis, what will happen? So we'll ignore all of that. Users of derivatives, basis. So this question, no, these kind of questions, I want you guys to remember specifically because of MCQs. And our institute is famous for kind of quality of MCQs that they ask. So what is basis? Okay, if they ask you things like that, basis is A minus B. What is it? Basis is difference between spot and futures. So spot minus future. Okay, what is contango? Futures price are always higher than spot. Elaborate. So futures are always higher than spot because there is cost of carry. Right? Normal market, generally spot price is lower than futures. In this situation, basis will be negative. Basis is negative. Basis is if spot today of, let's say some stock is 100, future is 110. So basis is minus 10. So basis is negative. Please note, I'm specifying this because potential for asking a question is very, very high. Okay. What is cost of carry? Cost of carry is basically the time value of money. Then backwardation. What is backwardation? Contango basically means that future is greater than spot. Backwardation means spot is greater than future, in which case basis is positive. Okay. What is convergence of spot and future? On the due date, typically both of them converge. My maintenance margin, initial margin, I'm pretty sure I'm not going to get into it. Okay. These are single stock, index stock futures. Why do people trade in futures? These are all important. But, what are European options, American options? I'm coming to more important stuff. And that is why I'm not trying to spend too much time on this. What are stock options, stock index options, current spot, impact of strike price on. So this is again another important aspect that can come in exam. If there is an increase in market price, call option value increases and a put option value decreases. There's a decrease in market price, call option value decreases, put option value increases. It's very simple. But related to this, they can ask questions. If it's what is the impact of strike price on pricing of an option? In the money option is if what is in the money, basically you have a right to buy at 60, the stock is already at 50. So the value of the call is already 10 rupees plus you have time value. Right. This is intrinsic value is already there. Wherever there is intrinsic value, there is already the call will obviously be priced highly. Right. Because intrinsic value is already there. You only have to factor in now for time value. Out of the money, only time value is there, no intrinsic value. At the money, there is some marginal intrinsic value, but a lot of time value. Right. So this is something that you have to remember. Then expiry, volatility. So when volatility increases, by design, the option prices go up. Okay, interest rates, Greeks. Now, I'll explain all of this in relation to Greeks. Last time, there was a question also asked specifically with respect to Vega. It measures the option sensitivity to volatility. It is a change in option price for a 1 percentage point. The key word, no, is 1 percentage point. Almost everybody whose papers I reviewed, they didn't write 1 percentage point. They just said it is the change in price of the option due to change in volatility. You have to specify that for 1% change in volatility, what happens to the price of the option. The Vega is very, very specific in that sense. And they purposely asked that only. Anyway, what is theta? Okay, theta is basically change in price of the option due to passage of time. Please note the word passage of time. It is not due to time to expiry, time to maturity and all that. The critical word is passage of time. It can also be referred as a time decay. It also referred as time decay. Please note these words. Then what is delta and what are gamma? Delta is change in price of the option due to change in price of the stock. It is very simple. Gamma is change in price of the option due to change in delta. Right? This is the second derivative. Gamma is second derivative, basically. Okay. Then rho. Rho is change in price of the option due to change in interest rate. If you remember the Black-Scholes formula, everywhere there is a risk-free rate that we use. So it is change in interest rate. Put call parity. A lot of students, so this unfortunately is not taught in the not there in the ICAI syllabus, but this is required for everybody to do solve a lot of problems. So the formula put call parity is C minus P is equal to S0 in S0 minus K into E power minus RT. Or you can say C plus K into E power minus RT is equal to P plus S0. So if you have the price of a call, strike price and spot price, you can find out the put price. It is very, very simple. This is one formula you have to necessarily know. Now, real story. Okay, this is where new stuff has come in. From here starts all new, fancy, weird questions. What are exotic options? Exotic options are class of options which structure, feature, and expiry different from plain vanilla. So call and put are plain vanilla. This is a exotic is even beyond call and put. There are complications in call and put. What are exotic options? Excise is sometimes is a hybrid of American and European. So you have four things: call, put, American, European. Then you have something called exotic. So this exotic may be in between here, or American call with some put. I don't know. I mean, it can be a variety. I will see what are the varieties, but they may have some features of American and European. They may have some features of call and put. They may be something else altogether. So it is very, very different. All right, difference between exotic and traditional. It can vary in terms of payoff and time of exercise. These options are more complex, and more exotic options are always traded in OTC. Exotic options are largely traded in OTC. They are not traded in your exchanges. Okay, what are various types of exotic options? This is the good question. There's one called chooser option. There's one called compound option. There's one called barrier option. And there's something called binary option. There is something called Asian option. There is something called Bermuda option. There is something called basket option, spread option, look back option. A, B, C, D, E, F, G, H, I, 9 option varieties are explained in our ICI material. These, and unfortunately, they give one line, two lines about each one of them. I have dealt this in detail. In fact, I'll show you this. Yeah, so again, at the risk of repeating myself and the risk of sounding as if I'm trying to just sell this course, that is not the intent. Okay, we have given this course for quite a few days in December, Jan free also. Okay, so the intention is not that. Intention is that anyone who needs to study all these new topics, we have them on our website at a very, very affordable rate. The rate is here, 9.99 on the screen, what you can see on the right-hand side. 999 for May 24. It is purely incremental topics. It covers both theory as well as practical questions with respect to additional topics that are added. Because in today's revision or any day's revision, I don't think I can do justice and teach all this, because this itself is some 26 hours, guys. So I don't think I can teach 26 hours in revision channel only in revision module only for new topics. So if you are interested, if you think this is something that you want, please go and buy. Okay, I've explained everything in depth. I know there are only 10 days, 12 days for exam. But if you want one or two topics, 9.99 I think is a fairly affordable price. Please go and figure it out. Okay, now coming back. So let us look at this. Chooser option. It provides so I don't think ICA will ask questions in depth about all of this. I don't think they have the intention. At least it doesn't appear. They may ask you explain four exotic options, or is this an exotic option? What happens in this exotic option? Or they may give you an MCQ also, which is why I'm trying to cover this. Chooser option provides a right to buyer of the option after a specified period of time to decide whether purchase option is call or put. Shit. So you don't know when you buy whether it is a call or a put. You can decide whenever you want whether it is a call or a put. The premium of such an option will be max of price of call option or put option at the time of the initiation of the contract. Wonderful. So you can, at the same strike, given the current spot, you can decide later on when you want it to be a call or a put, and the premium will be higher of either. Compound option. An option is also split fee option, or option or an option. Option on option. What is option on option? I have an option to enter into another option. So I have a call option to buy a call. Call is right to buy. So I have a call option to enter into another call option. I have a put option to enter into a call. That is, I have a right to sell a put call option. Then I have a right to buy a put option. I have a right to sell a put option. So it is multiple complications. Right. Does this option provides a right or choice, not an obligation to buy another option? Thus, it can be said in this option, the underlying is an option. Yes. And payoff depends on the strike price of the second option on the date of the exercise of the first option. So on the date of exercise of the first option, whatever is the strike price of the second option, you will choose whether to exercise the first option or not. Second option is priced higher than what is originally was, then the first option will be exercised. Right. Payoff depends on the strike price of the second option on the date of the exercise of the first option. So strike price of the second option. So I have a right to buy a new option at 10 rupees. Now the new option is already trading in the market at 11 rupees. You will buy the new option. Right. Barriers are four types. Two types: knockout and knock in. Knockout also you have down and out, down and in. Knock in also you have down and out, down and in. It's a very weird thing. They can be there for again calls, they can be there for puts. I'll tell you what is a knockout. Knockout is if the underlying asset price reaches a certain level, the option ceases to exist. So I have a right to buy something at 10 rupees. But if the market falls to 2, my option is invalid. Okay. Or if the market knockout, or if the market goes to 20, the option is invalid. Right. So down and out, down and in. Down and out means if it goes down, it is out. Down go knockout. Knockout means if the price goes down, the option will cease to exist. Down and in means if the price goes down, option will continue to option will come into existence. A knock-in option, the underlying asset price reaches a certain level, the option comes into existence. So if I have a right to buy something at 10 rupees, in case of an down and out, if the market price reaches 5, the option ceases to exist. In case of a down and in, market price reaches 5, the option will come into existence. Up and out. Up and out means the price moves up. I have a right to buy something at 10. The market price is 15, ceases to exist if it is an out option. If it is at 15, it is an in option, then knock in option, then the option will come into existence. Very interesting. It's called barrier. Binary. Binary is known as digital option. That is, this option contract guarantees the payoff based on happening of an event. The event does not occur, the payoff shall be pre-decided amount. If event does not occur, there will be no payoff. So if something has happened, I will get money. If something this is betting basically. Cash or nothing. That is, either I will get a predetermined payoff. Asset or nothing. Payoff is the value of the asset. So either I will get money or I will get an asset. So that is a binary option. Asian option. What is Asian option? Asian option is average price payoff. So Asian option, the payoff is max of average of spot minus strike. And for put option, strike minus average spot. For in the strike is predetermined, but the spot changes. In average strike option, spot is fixed, but the strike keeps changing. It can be average of the previous few days. So it's a very interesting concept. I don't think they will ask you all of this. Okay. I'm teaching you because, or I'm rather covering this because I believe that there will be some question coming out of this somewhere. You can get that 1 or 2 marks. Bourbon is a compromise between European and American. Okay, the exercise option is restricted to certain dates. So, or certain on expiration. So, American option anytime. European option only on the last day. Bourbon option on day 10, 15, and 30. Basket option is a type of contract. Value is dependent on value of portfolio. That is basket. Instead of single asset. Generally, value of this option is computed based on weighted average of underlying basket. So they are very, the spot price is weighted average of multiple things. Spread option, you can have bond yield, spreads, pay options, and all of that. Look back. In this option on maturity date, the holder of the option is given choice to choose a most favorable strike price depending on minimum and maximum price of the underlying achieved during the lifetime. Wow, what an option. For a buy call, holder can choose the lowest price at which the underlying traded during the life of the option. So I have a right to choose what is the strike price depending on what happened in the last 10 days. Then just hold on, I need to drink something. This is a completely new topic. Ideally, they should have added this in securitization and not in this one. I'm actually slightly surprised why they added it here. What are credit derivatives? Credit derivatives is a mechanism whereby risk is transferred from risk-averse investor to to an investor who wishes to assume risk. Right. They are types of credit derivatives. Credit derivatives are CDS, CDO. These are two types. They are discussed in our material. What is CDS? If the loan is given and that particular loan there is a default, I will pay you money. Okay, exchange of liability or risk. That's all. CDS is that's all. There are a bunch of things. What are various default events? How does it work? All of that. But underlying core principle, let's say you and I enter into a contract wherein if HDFC Bank defaults, you will pay me money. That's all. It is very simple. What are the default events? What do you mean by default is also covered? Bankruptcy. HDFC files for bankruptcy. If HDFC does not meet an installment or there is a restructuring of HDFC, any of those things like that happen, then you have to pay me money. That is a credit default events. What are main features? It is non-standard. It is private, not traded. However, ISDA, which is an international body, they came up with something which has some standard terms and all that. Can be purchased from third party. If I am buying a bond, I can also buy a CDS to protect myself from default risk. Cost of premium or CDS, positive relationship with the risk adjusted. That is, if risk is high, the premium is high. If I don't have a bond, but I buy a CDS, then it is called as a naked CDS. Uses hedging, arbitrage, speculation. You can go through that. I don't want to get into that. What are the parties to CDS? Initial borrowers. That is a reference entity. That is HDFC has borrowed from money from me. So HDFC is the initial borrower. Buyer called investor. That is I am buyer of protection. Seller called writer. You are the person who is giving me the insurance contract. How is it settled? There is usually physical settlement or cash settlement. Both of them exist. Then you have something called as credit-linked notes. What's a credit-linked note? It's a form of funded credit derivative. It is structured as a security with an embedded credit default swap. The issuer, allowing the issuer to transfer specific creditors to credit investors. The issuer is not obliged to repay the debt if a specified event occurs. So you'll understand this better. It's a structured note issued by a special purpose company designed to offer investors par value at maturity unless in difference entity default. So there is an SPV. It issues this particular credit-linked note. Basically, it says that if there is a default, I will not repay, just like a normal bond. If there is no default, I will pay it back to you. The purpose of this arrangement is to pass the risk of specific default to investors willing to bear the risk. So it is purely, so it is someone who wishes to not have the credit risk, but have the benefits of interest accrue to them. That is basically a person who will issue a CLN. Right. The CLN themselves are typically backed by highly rated collateral such as US Treasury securities. So you can go through this. Bank lends money to a company. At the time of the loan, the bank issues CLNs. So basically, they are transferring their credit risk. CLNs are bought by investors. The interest rate on the notes is determined by the credit risk of the company. So once CLNs are bought, that money is put in a collateral. The CLN's interest rate is determined by the risk of XYZ. The funds raised by issuing notes are invested in bonds. Okay, that I told you. If XYZ is solvent, bank is obliged to pay the notes. So if nothing happens, I will repay the money, whatever I have taken from you in CLN form. If the XYZ goes bankrupt, then the creator of the investors become the creator of XYZ and company and receive the company XYZ loan. So if this goes bankrupt, if XYZ goes bankrupt, I as an SP will transfer off all my XYZ loan to the investors, and you will now own that particular loan. Right. The bank in turn get compensated with returns on less risky bond investments funded by issuing CLNs. So the money that we got on CLN, I put it in bonds and I keep getting the money. Then you have something called asset-backed security. What are asset-backed securities is a very important thing. I'm pretty sure there is going to be a question on this either in this attempt or next attempt. There are a couple of questions I want to answer. Extend for 2 more days. Yes, we will extend because I have to finish all chapters. Then will this be available? Of course, this will be available. Some minor cuts I will make wherever I was not there for 1 hour, 10 minutes, 5 minutes, and all that. I will cut that out. Other than that, the video will be available at least till the end of the exam. So don't worry about it. ABS. Please note what is ABS. ABS is you have various receivables, various kinds of assets. These assets can be credit card receivables, home loan receivables, car loan receivables, all of them. They are pooled together and you create three tranches. In the three tranches, what happens is senior tranche receives the first installment paid by everybody. Mezzanine tranche receives any money, after the senior tranche is fully paid, money goes to mezzanine tranche. After mezzanine is paid, it goes to equity tranche. So if there is any default, the senior guys have very little default. If the home loan is defaulted or car loan is defaulted, the default losses are borne largely by these guys. The default losses are not, very little is borne by senior tranche guys. What are CDO? CDO is a ABS, but issued by an SPV. SPV is a business entity formed to collect collateralized debt. A CDO consists of a pool of debts such as auto, home loans, or other debts. It's a way of creating securities with widely different characteristics. So, a CDO is an ABS of consists of pool of debt. It is the way to put it is it's called ABS CDO. Just 1 second. Switch off the AC. CDO is in ABS issued by SPV. So ABS is what? Just pooling of assets and issuing different tranches. Whereas a CDO is ABS issued by specific SPVs with mixing a bunch of loans. Right. What are various types of the CDOs? Cash flow collateralized, synthetic collateralized debt obligations and all of that, unfunded, funded, partially funded, arbitrage. I'm not going to get into this because I don't think they're going to get into this depth. Let them ask first a simple question on what is CDO or what is an ABS. Okay. Risks involved in CDOs, they are structured products. There is a default risk, interest rate risk, liquidity risk, prepayment risk. These are normal risks that you associate with any bond. So here also, because you have mixture of multiple kinds of loans, there is multiple risks that you are exposed to. Please go through this. Next comes even more important topic. According to me, this is an even more important topic, real options. This also, if you have not already, seen this, my classes, or you've not attended anywhere else, this is very, very important. Real options is usage of option techniques for solving real world problems. So I will be covering this in questions that we'll solve. But before that, I want to tell you certain things. Financial option versus real option. They may ask you what is the difference, or they may ask questions about it. Our financial options have underlying assets. Here, underlying assets are projects in real options. Payoff is specified value. In real option, it is cash flows. Exercise period is mostly period of these options is short for financial options. For real options, it is longer. Approach, they're normally traded. They are priced. Real options are valued because there is no market, so they cannot be priced. Now, you can value them using binomial, risk neutral, Black-Scholes stuff, what we have seen for normal options. But the types of real options are growth. So please note, there are three types: growth, timing, and what was that? Growth, timing, and there is a third one. Abandonment, yes. Growth is you have an opportunity to do something so that you can grow. It is an European call. Timing is an American call. You can choose when you want to do. And abandonment is American put or European put, depending on what kind of an option it is. You can decide that you don't want the particular project, you're abandoning the project or something else. So even if some projects have negative or insignificant NPV, managers may be, what are various types of real options? Growth options. So even if some projects have negative NPV, some managers may be interested in accepting because it may enable companies to find considerable profitability and value add in future. This is the case of real option like a European call, is what I was telling you. investment in R&D, ads, acquiring rights, vacant plots, and all of that. Abandonment is American put. I have a right to dispose of. So basically, once funds have been committed, I want to stop. I have an option to stop because I realize that this particular project is no longer going to make sense. Right. That is, you have to evaluate that. We'll solve problems. Timing is American call. I will choose when I want to enter into this project. So this is, according to me, a very, very important aspect. You can definitely expect a question out of the last, half an hour, 45 minutes, whatever we've discussed. I'm pretty sure there is going to be at least a 2 to 3 mark question that is coming up. It can be either in form of MCQ or a theory question, or in case of real options, even a practical question can also come up. Okay, commodity derivatives, you've already discussed. There is nothing new in this. Participants of commodity derivatives, factors influencing commodity derivative pricing, all of these are past stuff. There is nothing new. What are commodity swaps? Embedded derivatives. Again, now they've come up with new stuff. Weather derivatives and electricity derivatives, if I'm not wrong. Yes. Weather and electricity. These are also new topics. And lessons from derivative mishaps. There are 3 case studies, very good case studies from a knowledge perspective. So these are also very good possibility for asking questions. So this chapter and your advanced capital budgeting decisions. Those are 2 chapters which have on which I have a separate revision video that I've already released. Right? Guys can go and read that. You can have a look at those particular chapters, and there is very high possibility that questions can be asked from them. Okay, so let us move forward. What is it? Weather derivatives? Several businesses like airline, juice manufacturing are highly exposed to weather. Please note, this is not insurance. Okay, this is not, you'll understand what I'm saying. To hedge the volumetric risk arising out of unfavorable weather pattern, a new class of financial instrument called weather derivatives have been introduced. It has underlying a weather measure like rainfall. Underlying of weather derivative is represented by weather measure. The primary objective of weather derivative is to hedge volume risk rather than price risk. Key is to hedge volume risk and not price risk. Because there is rainfall, my production is low. So I want you to compensate me or do something like that. First, whether all this is irrelevant stuff. Difference between weather derivative and insurance. Okay, insurance provides protection for extreme low probability weather events such as earthquakes. Weather derivatives used to protect from all types of risk, including uncertainty in conditions which are more likely to occur. In weather derivative contract is between the buyer and seller. The seller receives the premium from the buyer and all that. This is normal. In case no adverse weather happens, the seller makes a profit. Okay, this is normal. What are the issues in pricing weather derivative? Forecasting of weather and temperature modeling. These are the 2 primary issues. And of course, data. Getting data is very tough, especially in a country like India. Getting data is very, very tough. Then you have something called electricity derivatives. So by the way, I don't know how many of you are aware, electricity is also traded. There's an India Electricity Exchange, IEX. You can go and check it. I've explained this in the class as well. Spot electricity prices are volatile. So in spot market, you can buy and sell electricity because of issues like small market size, dynamic factors such as fuel supply, weather, transmission, so on and so forth. There are instruments which can help you hedge cost of your electricity. So largely state governments and sometimes large industries also enter into such kind of weather derivatives. This will help buyer pay a fixed price irrespective of variation in spots. Like other derivatives, you have forwards, futures, and swaps. What are forwards? Electricity forward represents obligation to buy or sell a fixed amount of electricity at a predetermined contract price known as forward price. And payoff is ST minus F. ST is spot price at the time T, and forward is your the forward price that you have agreed. What are electricity futures? These are contracts for delivery of certain quantity of electricity at a specified price and specified time. Sellers can sell a proportion of their production in future market, while consumers can buy a specific amount. They are standardized, they're organized exchanges, they are settled by financial payments rather than physical delivery. And gains and losses of electricity futures are paid out daily as opposed to forward contract. Then swaps. These are financial contracts that enable their holders to pay a fixed price for underlying electricity regardless of floating. If you remember interest rate derivatives, which we're going to discuss soon, In interest rate derivative, if you can take floating, give fixed, you can take fixed, give floating. You are basically swapping, right? You can do enter into interest rate swap. Same way, you can enter into electricity swap, wherein you will say, I will pay a fixed price regardless of floating rate and a floating rate that is existing. So I will give you for electricity at floating rate, you give me electricity at fixed rate. You can do things like that. Then, like electricity swaps, there are two types of swaps. Location, the multiple types. Locational is one swap, wherein the holder agrees to pay either or receive difference between a specified futures price and another location spot price. So you have a factory in one location, you have a your office is in one location. You can try and get a difference between. So you there's one swap, no, basis swap, spread uh, derivatives on spreads, right? So like that, you can have locational basis swap is one particular swap. These swaps are used to lock in fixed price at a geographic location that is different from delivery location. So you can have a variety of electricity swaps, electricity derivatives. There are locational swaps, basis swaps, which help in fixing a price at a very specific location, which is different from delivery location. And please go through all the electricity derivative aspects that we have discussed. I've covered it very briefly. I'm not saying I'm covering it fully because it is not possible for me to cover everything fully. It takes a lot of, it'll become a full class. And it is, I would rather do justice to that in my full class rather than doing it in a revision class where, I might, not give you a better picture because I'm in a hurry to finish a lot of stuff. Please enroll in full class. You'll get all of this very, very clearly. Then derivatives mishaps. What are the learnings from mishaps? Don't this I think actually is a good question. What are learnings from derivative mishaps that have happened around the world? And I'm so sad that they did not add a point on Lehman crisis 2008. That is the biggest derivative mishap. Anyway, they're very weird people, institute material. The first lesson: don't buy anything that you don't understand. This is so simple, right? Do due diligence before making treasury department as profit center. A lot of people want to convert their treasury departments into profit centers and earn money. That is not the right way. And always have risk limits and stay within the risk limits. There are specific issues that are detailed in the material. You need not get into all of that, but you should be able to write at least a couple of bullet points. If you read this, you'll be able to write. If you don't read this or if you don't go to the material, you'll not be able to write. At least write a couple of bullet points for each of them. And separation of front, middle, and back offices. Right. These are, of course, there's one couple of more. Ensure that a hedger should not become a speculator. So the person who's doing the transaction for hedging should not go and try and speculate. And you should carry out enough stress tests and scenario analysis. Okay, there are 6 points. For each of them, you have to write at least a couple of bullet points if a theory question is asked. For that, you have to read all of that. There is no point me explaining this. You read it. All of it is self-explanatory. Very, very simple. There is nothing complicated. You write a couple of points. You will be, I am pretty sure you will get the marks that you are required. Okay, so this can be asked even as an MCQ question also. Okay, fair enough. Now we have covered largely the theory portion of derivatives chapter, especially from a questions perspective, not from a conceptual understanding perspective. Now let us move to the conceptual understanding aspect of derivatives chapter. I have a bunch of questions also. I've noted them down. I think I have about 30 odd questions. Yeah, here. We're there with the questions. Now, do I cover these questions? Yes, I will cover, but I think before I get into these questions, basic concepts also need to be discussed. So let me go to the basic concepts, whatever are there, not the theory stuff, which is there for, which I've done from an exam perspective. Let us look at basic concepts. Yeah, here. What I wish to explain is very simple, nothing fancy. Okay, forward or future. Forward or future is spot plus cost of carry minus dividend. This is the first aspect. Then I'm pretty sure you know what is a put, what is a call. Call is right to buy, put is right to sell. Okay, this is two things. Then forward future, we discussed about this. Uses spot plus cost of carry minus dividend, and future value spot into e power minus RT. So this is one more thing I want to show you guys. So here in this, if you'll see e power r minus y, r is the cost of carry element, y is the dividend element. So you subtract the dividend yield from the interest compounded interest rate. So you can, so one more thing, when you're computing theoretical futures price or for theoretical forward price, if the data is given for you such that you can compute it using simple interest or compound interest or continuous compounding, please choose it. Please do choose the method based on the data given. If the data is simply, says 8%, 5%, things like that, and doesn't mention the word continuous compounding, do normal compounding. Okay. Unless E values are given, don't try and burn midnight oil, or don't try and spend too much time on getting the arriving at value fee. I will explain to you how to get E value also. That also is there. I mean, we have some calculator tricks. The calculator trick video is also available on our website. It is available in YouTube. If it is not there, I'll add it also. Calculator trick is nothing major. But I'm pretty sure the institute would give correct, the question would be very, very clear on what you're supposed to do. Right. So these are two things. And then now let's get into questions. I don't think I need to discuss anything else. Question number 5. First, we'll be looking at futures and forwards. Then we'll be getting into uh, our options stuff. And when we get into options, we'll discuss most likely the thing about, all Black-Scholes. Then more than Black-Scholes, I'm more bothered and interested about these real options, because real options are the ones in which a question is likely for you in the exam. Because that is a new topic, and I would presume that ICA would be smart enough, or at least would be wise enough to cover that particular thing in the exam. Okay. So give me a sec. I'll again need a break for 2 minutes because I need to stretch. Once I stretch, I'll join back. Just give me 2 minutes. I guess back after stretching. You guys have a choice to stretch at your home, but I don't have. I'm continuously sitting and reading out, right? So I need to stretch. Otherwise, back starts aching. Okay. First question that I have. First question that we need to discuss is question number 5. Currently, BSE is at 5,000. There is a portfolio value which is at 10 lakhs, 10,000. And risk-free interest rate is 9%, dividend yield is 6%. So 9 minus 6 will happen. Beta of the portfolio is 1.5, 1.5. We assume that a future contract of BSE with 4-month maturity is used to hedge the value of the portfolio for 3 months. So contract is for 4 months. The future, whatever the BSE future is for 4 months, because the 3-month future is not available. That's what is the assumption. They've said very clearly. But we need to assume, we need to use it to hedge a portfolio over the next 3 months period. One future contract is for delivery of 50 times the index value. So 5,000 into 50, 2,50,000. Then, based on the above information, calculate the price of the future contract. What is the price of the future contract? First, they're asking us to price of the future contract, and then they're asking us to compute the gain on short futures position if index turns out to be some level. So we'll figure out what the thing is. But what is this future contract logic? right? How do you price a future contract? Future contract is spot plus cost of carry minus dividend. Spot is 5,000. Cost of carry is, and I said use simple stuff if you're not given E values. So in this, purposely I'm doing this. When they give you E values, you can use E values also. Okay. In this, I don't want to use E values in complicate life. 9% into 4 by 12, which is basically for 4 months, because the future is a 4-month future. 9 months into 4 by 12 into 5,000. Minus dividend. Please remember, dividend always is assumed that is received towards end. So you are subtracting the dividend value, right? So 6% of the dividend into 4 by 12 into 5,000. So you basically get everything at 5,000 plus 5,000 to 4 by 12 into 9 minus 6. So you get 5050. 5050 is the value, theoretical value of a future, but your 50 lot size is 50. So you multiply it by 50, you get 2 lakh 52,500. What I said 2 lakh 50, no, that is incorrect. Why? Because you have to consider the value of the future contract into lot size to arrive at the value of a single contract, right? So what is the beta of this? Beta of this is 1. Whereas what is the beta of portfolio? Beta of portfolio is 1.5. So if beta of portfolio is 1.5 and you are using it to hedge using contract which is beta of 1, will you enter into more futures or less futures? You will enter into more futures because you already have a portfolio. You have to hedge the portfolio. You're long on a portfolio, so you have to short the index. Portfolio has 1.5 beta, but your future has only 1 beta. So you will enter into more contracts. So how will you enter into more contracts? 1 lakh, what is this? 1 lakh, 10 lakhs, 10,000. 10 lakh, 10,000 divided by 2 lakh 52,500 is normal if both of them have same beta. Okay. So you'll enter into 4 contracts, but because beta is 1.5, you'll have to enter into 6 contracts, right? That's what you do. Now, after 3 months, the value of the index is 4,500. So what happens to the index? What did they say? The gain on short future, if index turns out to be 4,500 in 3 months. After 3 months, if it becomes 4,500, you have to close out the old futures contract. Old futures contract was at what? 5050. When you close out, assume there is no MTM and daily settlement. Okay, just for you to understand. When you close out, you have to figure out the value of this index as applicable on if this is spot, you have to find out the future, the value of the 1 month future. Okay, that's the right way to put it. You know the spot value of the index after 3 months. So this is month 3. In month 3, this is spot. In month 3, what is 1 month future? Why? Because originally you bought a 4-month future, which is now become a 1 month future. You purchased a 4-month future, so you have to sell now a 1 month future to make that money. Or you have initially sold a 4-month future, you have to buy a 1 month future now to square off, right? So 4,500 is the value of index after 3 months. So the future value of a future based on 4,500 is 4511.25. So 4511.25 is the value of the future, which is maturing after 1 more month. And the value of the future that you purchased 3 months ago, which is again maturing after 1 more month, is 5050. So the difference between those two is you have shorted it, right? You have shorted it. So the difference between those two, why did you short? Because you have portfolio long. So you shorted a future. So because you have shorted a future, if the value of the future comes down, it is a gain for you. So what is the difference between these two? 5050 minus 4511. It will be something around some 490 or 500. What is it? 5050 minus 4511.25. 538.75 into 6. 3232.5. But each one is a 50 lot size is 50. So into 50, you get 161625. Okay. So I'm using a normal calculator for anything else. Right. So that is how you get answer for this. We have not used D in this. We have also, not considered one more thing. What was that? We have not considered the present values and all of that stuff. We've done a very simple thing, the simple question, so that you understand. Now let us come to the next question. Question number 7. This is again, these kind of questions have been asked in exam. A mutual fund is holding falling assets in rupees crores. Investments in diversified equity shares in cash and bank. So equity shares will have a beta, cash and bank will not have a beta, zero beta. Right? Cash does no beta. Total is about 100 lakhs or 100 crores here. The beta of equity shares is 1.1. That's what I was telling you. The index future is selling at 4,300 level, and the fund manager apprehends that the index will fall by most 10%. How many index futures should he short for perfect hedging? So if he has to hedge this perfectly, how much index futures should he short? Index futures have a beta of what? 1. Why? Because index futures are on, index is basically the market. Market has a beta of 1. Again, lot size is 50, substantiated answer, and also on and so forth. So index future value. Index future is currently selling at 4,300. 4,300. And how much shares do we have? 90. Beta of shares is 1.1. What is the value of one futures contract? They said 50 is the lot size. So 50 into 4,300 will give you 2,15,000. Value of equity shares. Do you hedge the whole portfolio, or do you hedge only the equity shares? Please note, you hedge only the equity shares. So 90 crores divided by 2,15,000, you need to enter into 4604 equity futures contracts. Just a second. $90 crores, right? I'm just checking the number. That's all, nothing else. Divide by 215. Right. So what happens here is each futures contract is 2,15,000. Equity shares are 90 crores. But this has a beta of 1, this has a beta of 1.1. So what the number of futures contract you should enter into will be 90 crores. 90 crores is 8 zeros. Okay. A crore is 7 zeros, 90 crores is 8 zeros. 8 zeros into 1.1, because that is their beta, divided by 2,15,000 will give you 4604.51. That is how you arrive at this number. Right? It is not simply a to 90 crores by 2,15,000. 90 crores by 2,15,000, you'll get a different number. So you have to multiply this by 1.1, because that is a beta of that particular portfolio, divided by 2,15,000. So you need to enter into 4604.65 or rounded it off to 4605 contracts. Right? If index falls by 10%, if index falls by 10%, the beta of this portfolio is 1.1. So the portfolio will fall by 11%. Why? Index is 10, beta is 1.1, so it will fall by 11. Right. So 90 crores into 11% is what? 90 crores into 11% is 99 lakhs, if I'm not wrong. Yes, 99 lakhs. Now, the loss on equity share is 99 lakhs. But what is because you've shorted the index futures, what is the gain that you'll make? 4605 into 50. That is the number of futures contract that you have entered into. And what is the index value? Index value is 4,300. So it has fallen by 10%, which is 430. So 4605 into 50 into 430, which will give you 99 lakhs and 7,000, or I think it is 9 crores 90 lakhs. I'm sorry, 9 crores 90 lakhs 7,500. So these two offset each other. Loss on equity shares is 9.9 lakhs offset by gain on futures, which is why hedging transaction has served its particular purpose. Okay, so it's a simple question. Please don't forget that 1.1 there. Don't blindly start doing things. Then let us come to question number 11. So forwards and futures is fairly simple. Na? Options is where all the complications start. On Jan 1st, 2013, investor has portfolio of 5 shares as given below. Right. These are the shares. This is the price. This is the beta of each share. So there is a portfolio. You can find out the portfolio beta also. Okay, I'll not get into that. What is the beta of his portfolio? That's the first question. So you multiply this, into beta to get the total value of the portfolio, multiply with beta, and you can do a weighted average beta. Beta will be 0.84907. I will not get into the working. You can do it on your own. Then theoretical value of Nifty futures for 2013. the number of contracts of Nifty the investor needs to sell to get a full hedge until February for his portfolio. The current value of Nifty is 5,900. So there on Jan 1st, it is 5,900. And you need to find out the Feb futures. Futures have a minimum trade lot of 200 units. Assume that the futures are trading at their fair value. First one is, what is theoretical value? Theoretical value is what? Spot plus cost of carry minus dividend. Have they given any dividend? They have not given any dividend. So you have to just find out cost of carry. So here I will tell you this cost of carry ke liye this thing, simple method, which is that calculator trick. No, what I was saying that we will discuss karke. It is already there in my one of the videos that we have made. Right. So E power, you are on 1st of Jan. So 1st of Jan, this is the price of the shares. Is it beginning of the day or end of the day? We don't know. We can presume it is beginning of the day or end of the day. So in Jan, you have 31 days, but already one day is over. So you have 30 days. In Feb, you have 28 days. I presume this is not a leap year. So you have 58 days. You can take 58 or 59, depending on the assumption that you choose to make. Okay. Now you have 59 days. And what is the thing? The number of future contract investors should trade if it desires to reduce the beta of his portfolio. The number of days in a year be treated as 365, and 1.105 is equal to 0.098, and this much is 0.105. Where is the cost? Where is the interest rate? 10%. 10%. Interest cost is 10%. So 10.5%. Right. So log natural log of 10.5% to the base E. Natural log is base E is equal to, they've given a value 0.0998. Okay, can you use this? 1.105. I'm sorry, not 10.5%, 1.105. So if you cannot use this, there is this easy way to handle it, which is, the calculator trick. E power 10.5% into 58 by 365. What will you get? 10.5% into 58 by 365. You will get E power 0.016685. Okay, 0.016685. Now in your calculator, normal calculator, what you have, you first enter this value 0.016685. Okay, then you divide this by 4096. Okay, you'll get a value. Then you add 1. Okay, you'll get a value. Then you do into is equal to 12 times. Into is equal to 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. So you'll get a value of 1.016824. Okay, 1.016824. Have they given anything? Okay, they've not given that. This is not working. None of these data points are actually making sense for us. So 1.016824. Right. So what you do, Nifty spot is 5,900. Cost of carry is this, and your days is 365, whereas the days that you require is for 58 days. So if you do this particular formula, you got 1.0168 multiply by 5,900. You will get 5,999.2668. Yeah, I got the same number. Okay, so that is the theoretical value of Nifty futures. The data that they've given, I don't think is of any use. Is it of any use? 5,900 into 1.01 598, 5994. Probably, I don't know. Or they took it as 2 by, they said take 365-day convention, no? Number of days, please take as 365. I don't know how they got point 105 into 59 divided by 365. I don't know what this number is, how they can use it. I don't know. Okay, leave it. Now we've got a theoretical value of the futures, then number of contracts of Nifty that you need to sell to get a full hedge. Now Nifty has beta of 1, whereas or futures have beta of 1, whereas the portfolio has a beta of how much? 0.84907. So, and the lot size is 200. So each transaction is 1199853. Why? 5999 into 200 is 1189. Now this, what is the value of the portfolio? Value of the portfolio is given as 188 lakhs. 188 lakhs divided by 11,99,000. 188 divided by 12 you take. So approximately 12 ones are 12, 68, 12, 5. Yeah. Right. So, okay. No. So what happens here is again, same thing what we did earlier, right? So what we did earlier was this 11 lakh has a beta of 1, whereas 188 has a beta of 0.849, correct? That is what is the question. 0.849. So you multiply 188 with 0.849. So 188.5486 into 0.84907 divided by, you do this number of 11,99,000. 11,99,853. You will get 13.3426, 286 actually. Okay, so you have to enter into 13 contracts. So this is the answer to next question, which is number of contracts that you should enter into. Now coming to the last question, the number of future contracts investor should trade if he desires to reduce the beta of his portfolio to 0.6. If you want to reduce it to 0.6, then you have to sell more. Right? How do you sell more? How much do you sell? Working is here. 188 into 0.89 will give you 160. Short Nifty. But what do you want your portfolio value to be? Portfolio should be 188, but with a beta of 0.6. So 188 into 0.6 should be 113. So the end goal should be 113. So 160 minus 113 is 46. You work backwards, and this 46 has a beta of 1. So you should short Nifty of 46 lakhs. If you have to short Nifty of 46 lakhs and each contract is 11 lakhs, you should short 3.91 lakhs. That is 46 lakhs by 11,99,000. Right, understood. So this is again a kind of a question that can come in the exam. Derivatives, the forwards and futures questions are fairly simple. That involve some working, but they're not too complicated. Okay, 11 is over. Next, come to 24, 27, 29. There are 3 more questions in futures and forward chapter. We'll do that forward section. We'll do that and wind up the session for today. Tomorrow we'll take up the options as well as if possible, the options and definitely the interest rate risk management chapters. Okay, those 2 chapters we'll try and do tomorrow. And probably if possible, 1 more chapter we'll do. Right, but today we'll finish with 3 more problems and then we'll wind up today's session. I think we're already at 4:30. It's been good 4-5 hours since we started. Right, illustration 24. This is another variety of similar question, but another variety. Somebody has a portfolio of 5 crores with equity shares of X and Y with beta of 1.15. The portfolio beta is 1.15. Other information, spot value of index 21,000 multiplier 150 are required to reduce the beta to 0.85 and increase beta to 1.45. One is through risk-free, other is through futures. So through futures, we just saw. Now we have to see what is risk-free. So let us see. And this one I'll move faster because I don't think there is anything new or novel that you're going to learn here. So portfolio value is how much? Did they say 5 crores? Portfolio beta is 1.15. Index futures price is 21,000. That's what they said, right? And lot is 150. Okay, this is what they've given. Reduce to 0.85 using risk-free. First, we will do risk-free, then we will do futures. 0.85 should be the desired beta such that some proportion of risk-free, which is let's assume the proportion of risk-free securities is RF, then 1 minus RF has a beta of 1.15 and RF has a beta of 0. Why does RF has a beta of 0? Risk-free, boss. There is no risk, so there is no volatility, there is no sensitivity, so it is 0. So risk-free securities have 0 beta, 1 minus risk-free proportion has 1.15. If you solve for this, you will get the proportion as 0.26, right? You get 0.3 by 1.15. So 0.26, which is 26.09% of the portfolio should be taken out in XY from X and Y and put in risk-free securities. So a total portfolio size is 5 crores. Out of 5 crores, you have to withdraw 26%, which is 1.3 crores, and put it in risk-free securities. Then the overall beta of the portfolio will come down to 0.8. Same way, increase beta by using same risk-free securities. If you take money and put in risk-free, it reduces the beta. If you borrow money and then put it in these securities, X, Y, X and Y in same proportion, that will increase beta. So 1.45 is equal to 1 minus RF, same logic, plus RF plus 0. So what happens is you solve for this and you get a value minus 0.26. That is, you borrow 26%. That is, you borrow 1.3 crores and invest it in these securities in the same proportion. Then your beta will increase to how much? 1.45. Right. Then using futures, same again, you solve the equation 0.85 into 5, which is basically the beta that you desire, is equal to 5 into 1.15 minus futures has beta of 1. See, in case of risk-free, the beta was 0. Here, futures have beta of 1. And you also don't need to find out the proportion because you're not withdrawing money. See, in case of a risk-free security, you have to withdraw money from 5 crores and put it. Whereas in case of futures, you don't need to do anything. So there is no reduction of portfolio value or increase of portfolio. You just enter into a contract. So which is why you directly take F. Right. So you solve for this, you get the future contracts, that is notional futures, you'll get it as 1.5 crores. That 1.5 crores, if you solve for it, you'll get 4.76 contracts. Same way, if you have to increase the beta, it will be ulta. Same 1.5 crores you'll get because you have to add beta by going long on futures, and then you will end up with same 4.76 futures contracts that you have to go long. It's a fairly simple question. Have a look at it. Obviously the description, everything is available with you guys. Obviously the entire PDF is available with you guys in the description that we have provided. Then last two questions, 27 and 29. This is an mark-to-market question. A lot of students have asked me doubts on this question in our forums as well, which is why I want to solve this. The price of Nifty futures is 9170. Minimum trading lot of futures is 50. Initial margin is 8%. Maintenance margin is 6%. Index closed at following levels: 9380, 9520, 9100, 8960, 9140. You're required to mark-to-market cash flows in daily closing balances. Investor, on account of an investor who has taken a position at initial date, 9170, who is long and who is short. Short is exactly ulta of long. Okay. With respect to gains and losses, not with respect to MTM. Please don't worry. Please don't get confused. Spot is 9170, lot size is 50, and these are the 5 prices of 5 days. Now, if you go long on Nifty, what will happen? You went at 9170. On that day, index did not move. What is the margin? They said margin is 8%. 8% of what? 9170 into 50 into 8%, 36680. So you add original initial margin of 36680. So that will be the closing margin. Maintenance margin that is required is maintenance margin is the margin that you always required to maintain. If it goes below maintenance margin, you have to recoup it till initial margin. Initial margin is what you put in initially. Maintenance margin is you want to maintain on a daily basis. But if the total margin goes down, why will margin go down? Margin will go down if there are losses. Margin goes down below maintenance margin, then you will recoup the margin to initial margin level. Margin is always computed on the latest price, latest future value, or latest value of the futures. Okay. Now, second thing, second day one, the market prices increased. This is futures only, right? futures contract 9170, the price of futures increases to 9380. So there's a positive movement of 210. 210 into your 50 lots. So you make a gain of 10,500. So original margin was 36,680. That has increased to 47,180. This is just a computation of initial margin, maintenance margin, how much is it required? It is not really relevant. Then next day also 9520, it went up by 140. Went up by 140. So 140 into 50 is 7,000. So your margin has gone up to 54,000. Then next day it fell dramatically by how much? 420 points. 420 into 50, 21,000. So it reduced from 54,000 minus 21,000, it fell to 33. Now you have to check maintenance margin. What is maintenance margin? Maintenance margin is 6%. 6% of what? 6% of contract value. What is contract value? Contract value is, on today's date, the contract value is 50 into this number, 9,100 into 6% is 27,300. So that is what is maintenance margin. Your margin is higher than maintenance margin, so nothing needs to be done. Next day again, it crashed. So by how much? To 9,100 to 8,960. So 140. So 140 into 50 is 7,000. So your margin is come down from 33,180 minus 7,000. So your margin balance is 34,280. I'm writing it somewhere here. 32,480. 32,480. That is the margin. That is the amount. This is maintenance margin you should maintain. But your margin has come down to 26,880. So you don't recoup only this. You come back and reassess the contract value and compute the initial margin again. So contract value is 8,960 into 50. 8,960 into 50 is 44,800 into 8%. That is 35,840. So 35,840. Your margin is 26,880. It is supposed to be 35,840. You subtract 26,880, 35,840, 8,960. Wait. 35,840 only, no? Yeah, so you maintenance margin is 26,880, but what is the maintenance margin is 32,480. It has fallen down to 26,880. So 35,840 minus 26,880. 35,840 minus 26,880. Did I make any mistake? So you bring back this amount of money and so that your closing margin goes up. 8,960 into 50 into 8% only, no? Margin into 8%. 35,840. 35,840 minus, what is your current margin level? Current margin is 33,180 minus 7,000. 33,180 minus 7,000. 26,180. So 26,180. So your margin is 26,180. And you're supposed to be 33,180. So 26,180 minus not 36,180, 35,840. You're supposed to maintain 35,840. So minus 35,840 is 9,660. Yes, 9,660. That's how you get 9,680. If any of you are confused, I'll repeat it this again. This is the only part where students have actually got confused. So opening is 33,180. But it is you have incurred a loss. Loss is how much? Loss is 7,000. So 33,180 minus 7,000 is 26,180. This is your margin balance. What is maintenance margin? Maintenance margin is 8,960 into 50 into 6%. It is 26,880. Okay. This is below this, right? So you have to recoup till initial margin. Recoup from where? From here. What is initial margin level? Initial margin is 8,960 into 50 into 8%. You have to bring it back to 35,840. So from 26,180 to 35,840, difference is 9,660. So you fund that money so that your closing margin is 35,840. Next day again, it increases, that balance adds to you, right? So the gain or loss, what you have made, that's gain or loss, mark to market and closing balance on account of this, and profit or loss of each contract. So what is the gain or loss that you've made? The gain or loss that you've made is, initially you added 36,680, closing balance is 44,840. So 44,840 minus 36,680, 8,160. 8,160 is the increase in margin, but out of that, you yourself have funded 9,660. So actually, it's a loss of 1,500. Just hold on for 1 second. I'll just drink some water and we will continue this. Just one more question, we'll wind up. Okay. Okay, coming back. Now you make a loss of 1,500. Just stretching, guys. Okay. You make a loss of 1,500. Same way you work on for short Nifty. For short Nifty, you will make a gain of 1,500. How is that 1,500? 9,170 minus 9,140. So the rate has gone down, the index has gone down by 30 points. So 30 into 50 is 1,500. That way also you can look at it. Right. So you can work this out on yourself. There is nothing complicated in this. In this, you add margin and then you look at the total margin. Opening, closing minus opening minus whatever you have funded, that is basically your gain. Okay, then coming to last question. Last question is question 29. This is a twisted question, which is why I wanted to solve this. After this, we'll go to options. Options, as I said, we will be doing it tomorrow. Okay. Question illustration 29. A company is long on 10 metric tons of copper, not million, metric tons of copper at 474 per kg. So you're already long on spot and intends to remain so for ensuing quarter. So I will be long. The standard deviation of changes of its spot and future prices. So spot SD is 4%, future SD is 6%. And correlation coefficient between these two is 0.75. Okay. What is hedge ratio? What is this hedge ratio? Where did this whole story come up? This came in RTP November 23. So this is why I'm actually trying to solve this, because I think one of these days they'll ask this question. They've never even explained this concept. So here hedge ratio is equal to correlation into standard deviation of spot by standard deviation of future. This is the formula specifically for this kind of questions. Now, how, why, and all that, if you remember, what is beta? Beta is the sensitivity of one towards the other, how much change one will have on the other. What is the formula? R standard deviation X by standard deviation Y. This is market. This is individual security. Same logic applies here also. The spot and future, right? So you take, and please note, guys, in commodities, a lot of commodities, spot prices are also determined by future prices. So people don't take necessarily decisions based on spot market will not decide. I mean, there is obviously spot will impact future, but a lot more impact is there on futures, which will come and hit spot as well. Okay, so correlation, standard deviation, S by standard deviation, F, which is basically the spot and future, you will get the hedge ratio, which is 0.5. So that is, when you look at this hedge ratio, it means if you enter into any transaction to hedge this is spot, right? So your futures have more volatility. So, and the correlation is 0.75 as we discussed. So what happens is, whenever you wish to hedge, you because futures have more volatility, you need to hedge lesser number of units of futures using futures. So there is a spot. Spot has low volatility. Futures has high volatility. Because it has high volatility, you will use lesser futures to hedge the spot. That is the logic. So for hedging 10 metric tons, you will use only 0.5, because 0.5 is the hedge ratio. You will use only 0.5 tons of futures of copper. So 5 MT of futures of copper will be used. Now, what have they said? Initial margin is 8%. So it should short to achieve a perfect hedge if initial margin. So they've not given us the futures rate. Let us assume the futures rate is very close to this or something related to this. So you compute 5,000 into 8% into 474 per kg, you get a value of 1,89,600. Okay, so this is a slightly, I didn't genuinely not like this question, because first, it is concept is not taught. Second, concept is complicated. It's not a fair question. And third, they have given half data here and there. Okay, so I did not like it, but then, it is what it is. We all have to follow what the institute says. Right. So we will wind up today's session here. We have solved problems, I think 25 odd problems in Forex and futures and forwards. Now, the next session we will do, I think, how many? 1, 2, 3, 4, 5, 6, 7. There are 7 questions. We will start tomorrow with options. And options, anyway, I did not do any theory also, except for that real options theory that we will do tomorrow in the next session. And then we will try and cover interest rate risk management chapter, where we will solve about 9 odd questions. Risk management, I think I've already done a revision for risk management chapter. You can go through that. But I think interest rate risk management chapter is something that we'll go through. So that winds up session for today. We'll have a next session where we will talk about options, key questions on options and theories specifically focused on, options as derivatives. Okay. Okay, fine. We'll wind this up. All the best. Have a great day ahead, and see you soon.